Morning. Welcome back to day 2 of the Municipal Finance Conference. Appreciate all of you who managed to get here early. Hope you appreciate the quantity of coffee, because you certainly need that to discuss municipal bonds, or at least I do. I know some of you have a somewhat different relationship with municipal bonds than I do. Just a reminder that this is on the record and live streamed, and that all the papers we're discussing, or most of them I think, are posted. Have we posted the slides, or are we going to post the slides? We have posted the slides. And we're going to use the same format as yesterday, 15 minutes for papers, 10 minutes for discussants, and 10 minutes for Q&A. We have 2 paper sessions this morning, 3 paper sessions this morning, and then we have a conversation with 3 mayors. I'll let you in on a secret, which I'll let everybody else in later. The mayor of Tulsa's flight was canceled, so we offered him the opportunity to do it remote, and he said yes, and then he just got up at 5 a.m. and flew from, or was it a 5 a.m. flight? 5 a.m. flight from Tulsa to St. Louis, so he could fly St. Louis to Washington, and then that flight was delayed so long he wouldn't be able to make it, so he went back to Tulsa, and he's doing it remote. So I think we're going to give him an extra 5 minutes. So I'm the chair of the first session today. The first paper is Winning at the Starting Line, Underwriter Connections and Municipal Bond Fund Performance. And the presenter is Bingwen Kao from the University of Nebraska at Lincoln, to be followed by our own Dan Bergstresser, who's the discussant. So the floor is yours.
All right, good morning. I'm Brian from University of Nebraska, and thank you for including the paper in the program. And this is a joint work with Russ Wolmers from Maryland and Zihan Ye from Tennessee. Okay, so this paper is about mutual fund in the municipal bond market. We know that mutual fund is the second largest player in this market. In aggregate, they hold about 20% of this $4 trillion market. However, in the literature, we don't know much about how they work, right? So we don't know much about how they manage their portfolios, what strategy they use to deliver returns, and how they compete in this market. Okay, and these are the answers we try to shine some light on in this paper. And we believe that municipal bond mutual fund is an interesting subject to study because they operate in a very unique market that is different from stock market and corporate bond market. We know that the secondary market of municipal bond is very illiquid, right? So a typical muni bond trade about 10 times in the entire year. And the trading cost for a muni bond is like several times higher than corporate bonds and orders of magnitude higher than stock, right? So, and as a result, this common strategies used by mutual funds that we are familiar with, like market timing, momentum trading, right? This strategy becomes unviable in this muni market. And so, and on the other hand, we know that municipal bond has a very active primary market, right? So the market has over 10,000 different issuers. They issue 100,000 muni bonds throughout the year. And this observation makes us shift our attention to the primary markets, and we're thinking that perhaps for this municipal mutual fund, instead of trading a lot in the secondary markets, they move their battlefield to the primary market and they participate and compete in this market, right? So that's our thinking process when we start this project. And indeed, we find that, although the average turnover for a municipal bond fund is low, is 27% in a year, a decomposition analysis showed that about 45% of these turnovers could be attributed to primary market purchases, which means that these mutual funds, they do participate a lot in the primary market. And a key finding of this paper is that the fund's connection with the underwriters play an important role in the overall investment outcome of funds in the primary market. We find that the connection with underwriters help funds to get more allocations in the primary market, and more importantly, they get more profitable allocations in the primary market. So here I just want to show you a general picture of this primary market of municipal bonds and the mutual fund presence in this market, right? So the first observation is that you can see that there's a, I don't things working. Okay, the first observation is that there's just a large number of issues over the years. Right? So this is statistics over a sample of 16 years. And which also means that there's selection in this market, right? So mutual funds need to choose, okay, which bond to invest. And another observation I want to mention is that, muni bonds are underpriced on average at issuance, right? And more so for large issues. And I'll define how we measure underpricing formally in the next slides, but basically you can think about this as the abnormal return of the bond earned in the first months after issuance, okay? And in terms of the mutual fund participation, we can see that mutual funds, they don't care much about small and medium issues, right? But they do participate quite frequently among these larger issues, right? And given a mutual fund participation, mutual funds do tend to hold purchase a large share of the issues. Okay, you can see even for the larger issues, the mutual fund could hold 57% of the entire issue, okay, given they participate. Okay, so this is the first key variables that I want to mention for our study. So to measure underpricing of a muni bond, well, the big problem is that, there are not a lot of trading in the secondary market, right? So what we do is that we first calculate the average transaction price for muni bonds over the first year after issuance. Okay, for most of the bonds on most of the days, there won't be any transactions, right? So, and once we get this average transaction price in the first year, we compare it with the offering price of the bond and calculate this roll returns of a muni bond first month after issuance. And then we benchmark this roll return against a ratings and maturity matched ICE muni index. Okay, and this difference is what we call underpricing. Okay, but intuitively you can think about this just as the abnormal return the bond earned in the first month. Okay. And another key variable in our study is this fund underwriter connection. So how do we measure this connection? Well, we rely on SEC filings by mutual funds in NSAR filing before 2018 and NSIM filing after 2018. Okay, so basically one of the items that fund need to fill out in these forms is the 10 principals with whom the fund has most transaction with, okay, over the past reporting period. All right, so in theory, these transactions include both primary market allocations and secondary market trading. Okay, but it's not a big issue for us because in this market there's a big overlap between underwriters and dealers, right? And once using these filings, we put together a list of reported principals by funds over time. Okay, and then we name match them to the underwriters of bonds emergent. Okay, and with this mapping, now for each bond, okay, issued in the primary market, we can observe whether a fund is connected or unconnected with the underwriter of that bond. Okay. Okay, so here is just show you some general picture on our fund sample. Okay, so we have a sample over 20 years, and there's nearly 1,000 municipal bond mutual funds in our sample. Okay, and the key statistics I want to mention here is to the bottom half of the table. So, on average, a fund holds 8.55 newly issued munis in their portfolio over a 3 months period. Okay, because we have quarterly holdings, and among these the 8.55 newly issued munis, 5.2 of them are allocated by the connected underwriters, okay, and the remainings are allocated by the unconnected underwriters, and this is also the source of variation we utilize in our main research design. So here, let me introduce the strategies we use to identify the role of fund underwriter connection. Okay, so we're looking at each portfolio disclosure of fund. Okay, and in each portfolio disclosure, we can observe some newly issued holdings in that portfolio, right? So, for example, in this slide, I show that this is a make-up example, but show that suppose that in this portfolio disclosure at the end of 2016, the portfolio disclosure reveals that this fund holds two newly issued bonds, bond A and B. Okay, let's say that these two bonds are underwritten by two different underwriters, okay, Bank of America and JP Morgan respectively. And suppose that this fund is connected only to Bank of America but not connected to JP Morgan. Okay? And what we're interested in testing is that whether the fund get more allocation, so they hold more bonds from connected underwriters. Okay, so the first step is we'll compare the portfolio weights or dollar positions, okay, between the connected bonds and unconnected bonds. And there's another layer of analysis is that we want to see if there is a selection effects here in the sense that whether the bonds allocated by the connected underwriters tend to be more enterprised. Okay, in other words, this becomes more profitable investment in the fund perspective. All right, so, and we think that this design is clean in the sense that it just automatically controls for all the fund level characteristics because we are exploring the within portfolio variations, right? So this is not about whether the fund is large or small. This is not about whether the manager of the fund is skilled or unskilled in choosing securities, right? So, and this is also automatic control for all the time varying factors, like the overall market conditions, COVID shock, or high inflation in some periods of time, okay? And so the numbers I'm showing here, this is our actual statistics over our full sample, okay? What we find is that indeed, funds get more allocation from connected underwriters. Okay, and the difference is 9 basis points. So that's roughly $1 million in dollar position. Okay, $1 million difference in dollar position. And there's also significant selection effects here. Okay, so the allocation from the connected underwriters, they tend to be more enterprised. Okay, at issuance, and the difference is about 21 basis point unconditionally. Okay, and basically these two comparisons summarize the key findings of this paper. Okay, so here is I just show the result in a more rigorous regression setting. Okay, so for example, in the first column I show that fund holdings in connected funds is 9 basis point more than unconnected bonds, okay, after we control for all the bond level characteristics, including ratings and maturities and so on and so forth, okay? And this 9 basis point difference roughly translates to like a 1.1 million difference in dollar positions, okay? And this table shows the results on enterprising, okay? So in this regression, the connected bonds tend to be 14 basis point more enterprise than the unconnected bonds. Okay, and this 14 basis point difference roughly translates to nearly 10,000 more value created for the fund. Okay, so this is definitely a meaningful source of income for the fund. Okay, and then we went through a bunch of robustness checks to further tighten our channel. So in the interest of time, I'll be brief here, but basically we show that this is not about issuer familiarity, okay, because there's literature showing that funds like to buy bonds from the same issuer, okay, and we show that this is not the case here. Okay? This is not, issuer familiarity does not drive our results, okay, and we also undertake a exercise that match holding transactions in newly issued bonds with MSRB transaction data. Okay, but here we focus more on the primary market transactions. Okay, and we find that this fund over 90% of these match transactions occurs on either the offering date or the next day. Okay, which means that the quarterly holdings of funds in newly issued bond is a good representation of the primary market allocation, right? And on average, funds pay very minimum markups against offering price. So generally speaking, mutual fund can get allocations at offering price without much markup at all. Okay. And so here is just rerun the analysis using the actual transaction price that we matched. Okay, and we show the robust and consistent results. Okay, and so this is the final set of results that I want to show today. So here I want to show at fund level whether the connection the fund has is associated with the overall fund performance. Okay, so basically what we're doing here is that we use the number of connections the fund has as a predictor for fund's future performance. Okay, and we find that across all the three measures of performance, more connected funds tend to outperform less connected funds. Okay. And so in this table, so this is a double sort of funds by size and connection. Is just to show that this result is not driven by size because larger funds tend to be more connected. Right. So and we show that this is not driven by size, but we do find that this connection effect shows up more among smaller funds. Okay, so I think I'm right on time, so let me just conclude. So I think, to our knowledge, we are the first paper to study this primary market activities for municipal bond mutual funds, okay? And we find that, well, these funds, they do participate a lot in the primary market, and we find that their connection with the underwriters played an important role in the overall success of the fund in the primary market. Okay, we find that, well, the benefits of having a connection with the underwriter is twofold, right? The first, they help the fund get more allocation from the primary market, and second, there's a selection effect there that the connection helps them to get more profitable allocations, okay, in the primary market. Thank you.
Do I use the clicker to advance? Great. Can you hear me okay? You guys hear me okay in the back? Awesome. So I like this paper a lot. To the extent that I have many things to say about it, it's a measure of my enthusiasm about what they're doing rather than any objection or nasty criticism. What the authors are doing is they're studying the primary market where new municipal bonds are sold to investors with the help of, via underwriters. If you think about the state of New Jersey might hire J.P. Morgan as their underwriter. J.P. Morgan would take a underwriting spread, which would be reported in the official statement. It might be 1% of the bond value would go to the underwriter explicitly. But then if you observe those bonds, right, so say J.P. Morgan bought the bond, then turned around and sold it, had an official price of par, so 100 cents on the dollar. But then if you observe in the period immediately after that underwriting over the next couple of weeks, if the price of the bond drifts up, then if you're New Jersey, you might view that as being money that has been left on the table in the underwriting process that maybe your underwriters didn't get sort of a good enough deal because you see the bonds, 2 weeks later trading at a higher price. There could be other reasons for that as well. This is something that people have been debating a lot. What exactly is going on with that tendency to see a markup in that primary market? But that's the question that the authors here are looking at, is like what's going on with that primary market? What we're going to call markup. It is a difference between the offering price and the price in the immediate post-issuance trading. The thing that the authors are doing, which is nice, is that they're going to the SEC's NSEN data. This is the new version of the NSAR data. It's annual reports where you can identify the key dealers with whom each fund interacts. And so you can create a measure of the intensity of interaction between fund managers and the different underwriters. That would be based on all of the transactions that they're doing, both the primary market and the secondary market trading. I would say there is no formal division between kind of primary market and secondary market. So, if a bond transaction happens 30 days post-issuance, you can imagine one person saying, well, that's still kind of primary market because it's 30 days post-issuance. But there's no formal dividing line there. With these data, the authors are creating a nice data set, sort of it's a new contribution on the intensity of mutual fund dealer interactions. It's a nice contribution. Mutual funds are an important part of the market. I would say looking forward, I think that the growth of separately managed accounts, like the market is evolving in a way that sort of evades the type of data work that is done here, because you wouldn't be able to do this with assets held via separately managed account. Like you can do this with mutual funds because they have to report this. What they're arguing is that in new issues, the mutual funds, if a mutual fund purchases a new issue from a dealer with whom it has a high-intensity interaction, those appear to be underpriced, which is good for that fund because it means in the first 30 days the price is going up, meaning that the fund is able to book some, you get some extra performance. Those issues are underpriced relative to new issues that are purchased from dealers where the underwriting dealer is not one with whom they have a close connection. So I went and got some of the data. This is the Nuveen, Kentucky Municipal Bond Fund. And one thing I would say about this paper, like, the muni world, you got some state-specific funds, you got some national funds, and I think being attentive to the differences across different types of funds in terms of regional focus will be important. But the Nuveen, Kentucky Municipal Bond Fund, these are the dealers. This is their data. These are the dealers with whom they're doing a lot of transactions, and this is the share of trading they're doing. So 26% of their trading is with Morgan Stanley. And this is what the authors here would use as their kind of a 0-1 measure of intensity. If you're on this list in their data, you would be a high-intensity relationship. Now, I think Morgan Stanley cares about Nuveen because Nuveen is big, but the directionality of the size is Morgan Stanley is very important to Nuveen. If I started a mutual fund tomorrow, say I'm running a mutual fund with $2 million in assets, Morgan Stanley might be very important to me if I'm doing all my trading with Morgan Stanley. That doesn't mean I'm important to Morgan Stanley at all. So the directionality here is, Morgan Stanley is important to Nuveen. You can imagine a different measure of importance, which is, are you important to Morgan Stanley? But that would be a different directionality of importance. The authors create a data set where each observation is a fund's holding of the newly issued bond. And then if you look at the 30-day, this is the key table, 30-day post-issuance price increase in the funds in the bonds for which that measure can be constructed. So you need some trades to be able to construct that measure. It's higher for the bonds that funds purchase from dealers with whom they have interacted frequently, which to me kind of raises the question, like, why in the world would you purchase a bond from a dealer with whom you've never interacted? Like, what's going on with those when a dealer you've never interacted with before is like, selling you bonds out of the ice cream truck down the street? That is also a question. It's like, well, what's going on with the other stuff? But it looks like they're doing better in terms of the underpricing on the bonds that they're purchasing from dealers with whom the intensity of interaction is high. Table 3, also, nicely written paper, very clear. Conditional on purchasing any of a bond. That's an important conditioning here. Mutual funds will purchase more of new bond issues from dealers with whom they have high-intensity relationships. And tables 9 and 12, I think this is really cool. Getting new issues doesn't automatically boost fund performance, but getting new issues from these high-intensity connection dealers does seem to boost their performance. So if you're running a fund and it seems like you're getting allocated a lot of newly issued bonds from dealers with whom you have high-intensity connections, like that does seem to boost performance. So I think this paper is very well crafted. I think the results are plausible. I know of funds for whom this is the strategy, like this is what they do. And so this is entirely plausible to me. My questions and where I want to push the paper basically boils down to, to the extent that you can, I'd like to see this result taken apart. I think that we can push harder in terms of understanding what's going on here by, for example, things like, I think doing hold one out analysis is really important. So what hold one out analysis is, take this analysis and rerun it, excluding every dealer one by one. Like, let's see if this, like, does this result still hold if you exclude Morgan Stanley? Does this result still hold if you exclude Vanguard? And you'll get a distribution of the key coefficients that tells you something about, that will be like a doctor diagnosing a patient. Like, that will tell you, wait a second, this kind of really hinges on having Nuveen, like this seems, I'm picking Nuveen at random, like this hinges on having this fund management company seems to do it a lot, or it seems to happen in negotiated issues, or it seems to happen, it seems to happen in April, right? It seems to happen when sort of, coupons are getting reinvested. I just think that taking the result and pushing along every dimension, like what types of dealers, what types of bonds, what time periods, is this something where if you could look at dealer balance sheet condition, like at times where the dealer community isn't stressed, where they really want to get stuff off their own balance sheets, are they particularly motivated to to work with funds with whom they have connections to offload this? And I think, there's a really good set of co-authors, and I think this is true of, many of the papers. Our notion of the potential for taking these data and saying, well, the paper is what it is, but if you look at what the Brookings folks have done with their kind of explore the data fiscal ship simulator, I can imagine taking this paper and creating a tool online where this type of analysis we could do. Like, you could say, well, here's our paper, here are the official tables, but here's also an app that lets you sort of run our results with the exclusions that you want to try. And that's not something that we've done for whatever reason in the profession. We've tended not to do that. We tend to sort of think, well, here is my paper, here's the internet appendix at best. But I think that going forward, I think that there's no reason in 10 years why a lot of the papers that are presented here couldn't also have like a sandbox place where people could play around with the data themselves. That's my comment. I've run 18 seconds over, but in summary, this is a great paper, and I appreciate it being on this program.
Thanks to both of you. I'm interested in hearing from people who are muni bond participants about this paper, but Brian, I have a couple of naive questions that I want to ask. So Dan raised this. So if I'm the state of New Jersey and I'm selling bonds, am I going to say, how am I affected by this? Am I getting screwed by this cozy relationship between the fund and the underwriter?
You mean from a perspective of like a retail investor?
No, from a taxpayer, from the issuer. If they're underpricing, are they like Dan said, are they leaving money on the table? Would New Jersey be better off if they weren't doing this?
I don't think so. I think so. Here in this paper.
Speak a little closer to the mic.
Okay, yeah. Here in this paper, we don't take a great stance on the issuer side of the market. Okay, so for most of the paper, our analysis, we take supply of the bonds as given, right? And when we look at the bond side,
I get that you're not taking a stand in the paper, but just thinking about this conceptually, if I'm an issuer, I care about the price that the underwriter is giving me for my bond, right? And doesn't this suggest that I'm getting screwed because the funds are cozying with the underwriter? Dan, I mean, you implied that, right?
New Jersey has been known to sue underwriters for this type of phenomena. Like if New Jersey, the offering price is 100, and then a month later you see it trading at 105. New Jersey has been known, states have been known to sue underwriters for not doing a good enough job of getting that 105. Now an underwriter can defend itself by saying what we do is kind of hard. Actually, we buy at par, but then we have to break up this issue into all these retail size pieces. So in general, there is a defense that can be mounted.
And Brian, Dan?
And I want to add to that is that if we compare the annual pricing of muni bond with like equity issuance, right? The annual pricing is quite small, like it's less than 0.5% on average even for large issues, right? So there are arguments on.
I mean, comparing IPOs
right?
in
So
stocks.
why IPOs are so underpriced, right? So the first day return for IPOs could be like 20%, right? I think it's like around 10% on average. Right, and the arguments there is that well, at least the story that I'm more into is the winner's curse, right? So in the sense that if those issues are priced too correctly, then only informed investors participate, right? Uninformed investors will not participate in that market, which sort of shrink the capital available to invest in the primary market.
And did you talk to any funds about this? Is this a phenomenon that they recognize?
Yes. So my advisor Ross Warmer. So we set up a meeting with T. Rowe Price, the expert there, and they also find this story quite plausible.
So why do they buy from unrelated underwriters then?
So the idea is, so my understanding is that it's still a binding constraint for them, right? Like ideally, of course, they want to always get profitable allocations from connected underwriters, but it's not possible all the time.
Not enough. Yeah, I see. All right. So someone from the industry, does this make sense to you or not? Yeah, please.
Actually, I work with T. Rowe Price.
All right. Good. All right. That counts. No. So wait for the mic, and thank you for identifying yourself. Let's make that a practice.
Yeah, so I'm an analyst at T. Rowe Price, and it's been a great conference so far. But yeah, so I would assume that a lot of the mispricing, it's a supply-demand problem. We can't get enough bonds when we go through a negotiated transaction. We're a big investment firm, so we'll probably get more than our fair share of an allocation, and everybody else who didn't is going to bid up those bonds in the secondary market. The question I would have for you is that a lot of, at least at the state level, a lot of those states have mandates to issue bonds during the year, both negotiated and competitive. And I'd wonder how that impacts the sort of mispricing based on the allocation. I know Illinois is required to do it by law. I believe New Jersey does it as well. It'd be a much smaller subset, but I'd be curious if that still shows up between the competitive and negotiated deals.
Yeah, so we use this type of deals as a control variable in the regression, right? So, but we do find consistent results, across both set of issues, and on average.
Yeah.
Oh, sorry. And on average, bonds are less enterprised for competitive deals, right? But the result still holds. Okay.
Hi, my name is Kalen Dwyer. I'm with Columbia Capital Management, so I'm a market practitioner as well. David, you're asking the right questions, and the answer is yes in some instances. So it's important to realize here that banking relationships should be in a spotlight here with muni bond issuers. Some of these folks have long-standing relationships with these banks, some of these bond issuers, and to the extent they're leaning on these banks to get an idea of what market prices are for the bonds they're selling, they're asking the person that's going to buy the bond from them what the market price is. So there's a natural conflict of interest there because the bank's serving two masters. It's serving the funds it works with, as we saw here, and it's serving the issuer that it's buying the bonds from. It's a buy and sell. So yes, excellent presentation, excellent topic, very important work. Appreciate it. Thanks.
Thank you.
In the back, Mr. Erdman.
Yeah, Dave Erdman from Baker Tilly Municipal Advisors and longtime issuer. Great paper, and it's just the tip of the iceberg. And David, you are asking the right questions. Anytime underpricing comes up, you also are like, but this is, the bond issuance process, negotiated sale versus competitive. When I did a negotiated sale, I was involved in the allocation process to make sure the bonds were equally distributed amongst a bunch of investors. I thought that was important as an issuer in order to have more people hold my paper. But sometimes in the negotiated process, you have a bad market and you need those anchor orders. And you rather recognize that someone stepped forward and was that first order that came in at a certain price. How much do you reward them for this transaction, but also realizing this isn't a short-term race, it's a marathon. You may need T. Rowe Price to step up in the next transaction in order to support a deal. So a lot of variables here that you probably can't really document, but it's just the reality of the process.
Thank you for the comments.
You want to take the one right by you, Lorraine?
Hey, good morning. My name is Paul. I'm from the state of Illinois, and our team issues the bonds for the state. And we do issue both on a competitive and negotiated basis. And the results vary, but we have found that, as Dave was saying, and I've learned a lot from Dave, first of all, what you're describing, I think what you're describing is known as trading on the break, is when the bonds trade. But we've seen both. We've seen mixed results and good results from both methods. And we have found that doing competitive and negotiated helps keep the negotiated honest to a certain extent. I mean, because it's pretty clear. But at the same time, the dealers are bidding our bonds where they think the market is, basically on spec. I mean, it's not like a negotiated process where they're building a book and they know exactly how things are going to be sold at the end of the day, or at least, have a pretty good idea of what the subscription will look like. So the dealers are taking a risk, probably arguably a much bigger risk in a competitive market, because they need to know they can sell a certain percentage, or at least have a pretty good idea, but they don't know. And if you hit a bad market on a competitive deal, you're high-centered. Whereas on a negotiated deal, you have the ability to negotiate with the investors through the desk, reprice, do a number of different things. So it's a bit of a mixed bag either way. And in a negotiated sale, we do recognize that it's an arm's length transaction with the dealers, and that they are looking for business from the issuers, but at the same time, they don't have a fiduciary responsibility the way that Columbia and other issuers and other entities do in the sale.
So why don't we take both those two questions, Brad over here, and there was one over here. Take them and then try and wrap up.
Hi, Brad Went with Charles River Associates. During the breakout session yesterday, we were talking about the decline in gross spread for underwriters. And many of us in this room remember the good old days when it was 1% in terms of compensation for a new issue. And the most recent data that I heard in the room was maybe 20 basis points, 0.2%. And I think we'd be a little naive if you're asking broker-dealers to take massive risk earning 20 basis points. And I'm not saying it's done one way or the other, but I'm just making an observation. So one thing I think might be interesting is with all your data analysis, you certainly have access to the gross spread that was paid to the underwriter. Yes. Was there a difference to the underwriter where he or she was receiving a half point to underwrite the deal versus a highly competitive situation where you had 14 banks competing for it? Let's say wonderful firms such as Merrill Lynch won it, BAML won it for 10 basis points. What did that do to their appetite to take risk? And that's measured in the fact that, as you've shown, they trade up after a 30-day period.
Right, thanks. And over here?
Yeah, thank you. I'm Luis Navarro, graduate student in IU Bloomington. I'll be brief. Your results suggest that the connectedness of the underwriters implies some, underpriced. Sorry, like the bonds are underpriced. So I'm just wondering if there is a room for, a market competition story, and like if we can talk about this measurement of connectedness as market power, and whether that implies that your results could be viewed as a markup that they charge for their prices.
I see. That's a good point. I think it relates to Dan's comments on what happens if so. Is the result driven by several very large dealers in the market, and this is not a very diverse market. I believe the largest 5 underwriters take up about 40 to 50% of the entire underwriting business. Yeah, and we haven't. So I'm working on this, but I don't have any result on top of my head. But I do believe that the results should hold, both for the national large underwriters and the small underwriters who have less market power.
And Brad's question about the size of the gross markup?
Right. So the size of the growth market is on the other side of it's on the supply side of the municipal bond issuance. It's not what we measure here. The market we measure is on the secondary market returns after the bond issues. Right. It's against the. So it's the transaction price against the offering price.
Right, but do you have that? Do you have the gross markup? Can you see it?
Yes, I think Emergent, they do provide growth spread, but I don't think it's good. It has good coverage. That's how I remember. No, not at all?
Yeah, it's like barely coverage.
Yeah.
It is reported in 10Ks, but it's not reported very good.
Yeah, so
You
that's
can
how
get
I
it in
remember.
Texas. So I have a paper where you get it for Texas, but then your results, then your results are just for Texas.
Okay, Brad, you should do this offline because we're out of time. I'm
Just
over.
one quick comment. In your presentation, it was 15 basis points you thought it would be. It'd be interesting to see if instead of being paid 20 basis points gross takedown, if 35 basis points would have eliminated that pricing discrepancy that you cited.
Okay, I'm cutting it off.
Yeah, thank you for the comment.
After praising every other moderator for sticking to time, I've gone over. So our next paper is From Arm's Length to Arm in Arm, Banks and Municipal Bond Financing, and the presenter is Igor Acuña from the University of Kentucky. Oh, and I should say that the discussant is Kayleen Dwyer from Columbia Capital Management.
All right. So I'd like to thank the organizing committee very much for including this paper in the program. It's great to be back here on the stage. And thank you guys for waking up so early here to see this presentation. It's awesome to have an opportunity to present in front of such a specialized audience. So look forward to your reactions to the paper. Right? So this is joint work with Gustavo Cortes at the University of Florida and Sharjeel Huq here at the Federal Reserve Board, and the usual disclaimer applies, right? So the views expressed in this paper are those of the authors and do not necessarily reflect the views of the Federal Reserve Board or the Federal Reserve System. So let me start my presentation by talking a little bit about the importance of banks in the municipal financing world, right? So banks currently hold approximately 20% of all of the municipal bonds outstanding, and there is a growing robust literature that shows that there is a big benefit of banks' demand for municipal bond issuers, right? So bank demands associated with decreases in financial constraints, decreases in financing costs, improvements in both the quantity and the quality of public good provision, and even improvements in local economic conditions, right? So one limitation that this literature has is that they do not know precisely what's inside the bank's municipal bonds portfolio, right? So this is confidential data. So what these papers do is basically rely on either a regulation or some form of friction that will make a bank more likely to hold certain bonds vis-a-vis another bond. So they will compare the outcomes of bonds that are likely to be held by banks versus bonds that are less likely to be held by banks. And this generates a little gap, right? Because then basically there's a gap between the bonds that they are likely to hold and the bonds that they actually hold, okay? So although they were able to answer all of these questions with this limitation, there are some questions that were impossible to solve or to answer, and that's where we're coming in here, right? So we are going to get full visibility of all of the municipal bond portfolio of the largest U.S. banks, right? So we're using Fed's data on the Y14Q collection, which is basically the data that large banks send to the Fed for stress testing. So this data will allow us to see every single bond that they are holding during between 2014 and 2022, right? So, and this will allow us to answer a few questions that the literature was not able to answer, namely here, right? So one, what factors go into the decision of these banks to hold certain bonds, right? So what makes a bond more likely to be held by a bank? And the other things that we're going to be able to speak a little bit more about the mechanisms driving the effects of bank demand on municipal bond issuers' outcomes, right? So we're going to basically answer how and why banks help municipal bond issuers, okay? So let me go over just a quick summary of my results in case I run out of time, right? So I think that the surprising element, maybe not surprising for this audience here, but relationships really matter on the bank's decision to hold a bond. Of course, banks look into other characteristics. They prefer high-quality bonds, so they prefer larger bonds with long maturities, high credit ratings that comply with the regulations that they're subjected to. But once we factor in relationships, the banks become way less sensitive to these characteristics of the bonds. Like, so basically, relationships is what matters the most according to our results. We're going to go through a significant effort here to try to provide causal evidence that these relationships matter in these decisions. And then we're going to go one step further and try to understand why is that the case. Right? So I'll show you that this is not really obvious that these relationships should matter, and we're going to show you why. Right? It seems like banks are extracting information from this relationship to improve the performance of these bonds, right? So like their bond portfolio. And for issuers, we see that these relationships help them both in good times and bad times. Right? So in good times, when financing costs are going down, we see that if you have a relationship, your costs will go down further. In bad times, when financing costs are going up, we see that like relationship serves as a stabilizer, and your financing costs will not increase as much. Okay. So before I go into the details of the paper, let me just talk a little bit about the contribution of the paper. Right? So we're making contributions to two strands of the literature here. Obviously, like we're in the literature that talks about the effects of bank demand on municipal financing. There's a large literature studying that with many people here in the audience right now. So I think we offer a couple of contributions to this literature. One, we are providing visibility to this data that was not visible to the literature, providing details of banks' municipal bond holdings. And we're showing the importance of bank relationships, both in the decision of banks to hold a bond and also as a mediating factor, as a channel, right, through which banks' demand affect municipal financing. And then we're also in this literature of banking relationships, where they show that like banking relationships are especially important for small corporations that are bank dependent. We are breaking away from that, and we're showing that relationships can be important in arm's length transactions that have market prices, and that can also be important for presumably financially unconstrained issues. And I'm going to go into more details of that soon. Okay. So this would be the point in the presentation in which I would like stop and brag about the data. I would show you everything that we can see that you guys cannot see, but here I don't have time. David said already he was going to push me out of like the stage if I go over time. So I'm just going to show you one result, okay? So we know that banks hold approximately 20% of the current, the total municipal bond market, right? So what we did here is like, what about the bonds that are in their portfolio, right? So just if we just focus on the subset of the bonds that they are holding, what percentage of this market do they hold? And this is the answer. They hold up approximately 60% of the total amount issued by the bonds that they hold. And this is not a short-living thing, right? So they buy 60% at the issuance, and then they hold it for a long period of time. So you see that even 5 years later, they're still holding 60% of those issuances, okay? So they are very important for the subset of bonds that they are holding, okay? So now, let me motivate a little bit our decision here to engage with the banking relationship literature, right? So when we started this work, we had many angles that we could have explored, right? So we decided to draw lessons from this very large literature in banking relationship that basically shows like two things, right? So that banking relationships can be very important for small corporations that are bank dependent, right? So these corporations can reduce their financing constraints and reduce their financing costs by engaging in these relationships. While for banks basically use the relationship to extract information from the issuer actually not even an issuer, right? Because it's a bank loan, but like they extract information from the relationship to basically extract rents from this small corporation, right? So you might be asking yourself now, like, okay, so if we already have all this overwhelming evidence that banking relationships matter for corporations, why would it be surprising that they would also matter in the municipal financing world? And there are at least like two reasons to believe that these lessons would not go through, right? So one of them is that municipal bonds are publicly traded, right? So in this case, like we have arm's length relationships and prices are set by the market, right? So in this case, there is like less scope for banks to extract rent from these issuers. And the second issue here is that we're dealing with like large issuers that have like stable streams of revenues, that have implicit guarantees from higher level governments, right? So I don't think that we would characterize these guys as financially constrained. So those are presumably financially unconstrained issuers that will likely not really benefit much from a relationship. Okay, so that's basically what we take to the data. We say, okay, so it's not really obvious. Does this actually affect the decision, or does this affect this relationship between the two? And the answer is yes, right? So basically, banks are much more likely to hold bonds that they have some form of relationship with. We have 3 measures of relationship: underwriting, credit, and repeat holder relationship, and they affect the decision of a bank to hold a bond. And of course, there are other things that they also take into account, like so banks prefer larger bonds with longer maturities, high credit ratings, and that comply with regulation. But once we interact these 2 elements, we see that they become almost insensitive to all these other characteristics. And it seems like relationships is the most important factor here in their decision to hold a bond, okay? So in these models here, we are saturating the model with a bunch of fixed effects to make the 2 groups comparable, but we obviously have an identification challenge here, right? So this matching may be endogenous, right? So there might be a new factor, like some omitted variable that is happening at the same time that basically is explaining both the decision of the banks to hold the bond and also to have a relationship with this bank, right? So maybe there's a high quality, something was revealed recently and that basically explained the decision to do both, okay? So in order to try to provide causal evidence of the relationship or the effects of relationship here, we're going to explore a regulatory change that increased banks' demand for municipal bonds, associated with an identification strategy similar to Kwajin Mian 2008, which for those not familiar with this identification strategy, the idea here is to include issuer times year quarter fixed effects. So now our evidence is for the same issuer in the same time, okay? So now basically what we're doing here is we're looking at the decision of 2 banks to hold the same bond. One bank has a relationship with the issuer, the other one doesn't. If quality was the only thing driving the decision to hold a bond, we would expect these 2 banks to purchase the same amount of this bond following this regulatory change. Now, if relationships play a role above and beyond quality here, we would expect that banks with a relationship would hold a larger amount of these bonds than issuers without this relationship. And that's exactly what we find. We find that banks with a relationship hold or purchase a significantly larger amount of bonds that they have a relationship with, right? So for an underwriting relationship, we find that they purchase 40% more bonds than banks that do not have a relationship following this regulatory change. And for a credit relationship, we find that they purchase 60% more than banks that do not have a relationship with the issuers, okay? So basically, this is our causal evidence that relationships matter here, okay? So now the question is, why would these relationships matter, right? Like I said, it's harder for banks to extract rents here, and it's not obvious why issuers would need this help because they are presumably financially unconstrained. So we provide some evidence of the gains that both banks and issuers are getting from the relationship here. So the first thing that we find is that banks have a stronger performance for the bonds that they have a relationship with, right? So here what we did, we calculated the returns of the bond holdings that they have, and we compare bonds that have a relationship with the bank versus bonds that do not have a relationship with the bank, and we see that they present a stronger performance for the bonds that they have a relationship with, right? So then our takeaway here is that banks are extracting information from the relationship to know more about the issuer than the rest of the market and getting stronger performance from their holdings, okay? And then finally, what we did, okay, so what are the gains for issuers here? All right, so again, those are financially unconstrained issuers that would likely be easily get access to financing. So then what we see here, we explore 2 settings here. The first setting that we explore is a positive shock. So we revisit this regulatory change that increased banks' demands for municipal bonds, which basically reduce the financing costs of many issuers. We see here that the financing costs of issuers that have a relationship with a bank went down even further than the average. And we also study here bad times. Right? So we go back and look at the financial crisis and see, okay, so in a moment where everyone's experiencing an increase in their financing costs, what's happening with issuers that have a relationship with banks. And again, what we observe here is that their financing costs do not go up as much as the rest of the group here. Like we see that they actually benefit from the relationship as well in bad times, okay? So to conclude here, right, so we have access to this unique data set that allow us to have unique visibility into the bond portfolios of banks. And we're showing here that relationships really matter, and that banks benefit from these relationships because they get stronger performance from bonds that they have a relationship with. And issuers are getting both better terms in their issuances in good times when they have a relationship and also in bad times. So like both the relationships help improving the terms of the deals in bad times and stabilize during bad times. Okay, so I think we're adding to this mounting evidence that we have in the literature that banks are very beneficial for municipal bond issuers. And I think that the policy implication here that we can have is that probably having more involvement of banks in this market will be beneficial for the issuers. Okay? Thank you very much.
All right, Kalen Dwyer, Columbia Capital Management. So I am a practitioner in the industry, and I've been doing it for about 14 years. What I do is I provide financial advice to cities, states, local governments who are actually issuing bonds. So we help structure deals, review the offering and legal documents, and then negotiate with underwriters on behalf of our clients to get the best deals that we can. So I'll reiterate it. I said it a moment ago from the audience. This is really important work. These topics, bank relationships with issuers, the relationships and the implications for the municipal market, it's hard to overstate how important these are. And they deserve as big a spotlight as we can give them. You know, so our market or our industry as municipal advisors, the regulatory framework is pretty much brand new. So I'm not very old, and I worked in the industry for 4 years before we were actually regulated and had a fiduciary duty to our clients. We've always served as fiduciaries, putting our clients' best interest at the foremost, but the regulatory framework itself is still pretty green, and everything's still settling, and it takes time for things to come into place. So as we examine relationships, legacy relationships historically that banks have had with issuers, and we highlight the importance of having a fiduciary advisor on a lot of these deals and the value that we can bring to the table, I think that's, to the extent we can spotlight that, it's very important. So I'm going to start with discussing in practice the things I see borne out in Igor's work. Banking relationships during crises, having a banking relationship, a close banking relationship during a crisis for an issuer helps lower the yields. Absolutely, that's true. Nobody wants to help you navigate troubled waters more than the person that you owe money to, right? So it's incredibly important during times of financial stress where if you need to access the capital markets, banks are going to come in, especially if you've got a working relationship with them already, and they're going to hold your hand as much as they need to try to get you a good deal. Very, very important. Absolutely see that play out. In stable times, as Igor's paper mentioned, banking relationships, it looks like, might correlate on the other side of the table there with slightly higher yields, which is intuitive. The difference was only a couple basis points in the paper, which isn't huge, to be honest. But the result itself is intuitive directionality-wise because relationships tend to be sticky. And if you're an issuer and you've worked with John at XYZ Bank for 15 years, that's your guy. I'm going to call John, and he's going to tell me where yields are, and we'll get some bonds priced, and and raise some capital. So because relationships are sticky, you don't always get the natural competitive nuances there, competitive forces that a competitive sale, for instance, might bring to the table. And as a result, maybe you might suffer in yield a little bit. Igor mentioned the regulatory changes from 2014 to 2017 that kind of that took hold with respect to bank liquidity coverage ratios and what investments are or are not considered HQLA or highly high quality liquid assets for banks. The fact that munis, as of 2017, investor grade munis are considered HQLA that banks can hold to meet their liquidity requirements absolutely improves demand for munis. It's a huge reason that we've got so much demand, and demand, of course, lowers yields for issuers. So very important. All right, a couple technical notes here on the paper as I check the time. So the term reoffering yield, and this is going to apply to a lot of papers I think we see in this space. Folks should be really careful when they're talking about reoffering yields and using reoffering yields in their analyses. Any reoffering yield for a bond that is callable is going to be distorted by the fact that it's going to be distorted by the size of the coupon, the effective yield. So so bonds, of course, are priced to yield the worst. So the yield, when you pull up an offering document, official statement, you're going to see the yield on the inside cover page there, and that's going to tell you the yield to worst, which if it's a premium bond with a large coupon, it's going to be the yield to the first optional redemption date, the call date. If it is a discount or par bond, it's going to be the yield to maturity. Okay, so if you just take reoffering yields, you're kind of, depending on how you do the analysis, you might be comparing apples and basketballs here by taking a yield to the call date and a yield to the maturity, and that can grossly distort the analysis. So it's very important to control for coupon size to the extent you can when looking at primary reoffering data. Igor, in your paper, you mentioned longer maturities are larger. Absolutely true. A longer maturity, say a 30-year bond, is going to be larger than a 10-year bond. And there's a very simple explanation for that. So kind of like your mortgage, you got level principal and interest payments over time. Your payment doesn't change on that P&I structure there. But as you pay it off 10 years, 15, 20 years down the road, the principal portion of that same payment becomes bigger. That's just an artifact of having level debt service over time. So I think the explanation is simply that. That's kind of the default standard in the industry. It helps, but when you're a municipal issuer and you've got budgets and you're planning for the future, it helps to have level debt service. So that's kind of why it's the norm. That's the convention. Another important technical note here is to remember that bonds are priced as series in the competitive market. And this is really, really, really important because if you're looking at bonds and comparing reoffering yield on a maturity by maturity basis, which a lot of these analyses are going to do, you've got to realize that the bonds were purchased by the investment bank as a basket. And that investment bank offered the lowest yield to maturity for that entire series of bonds, not each individual maturity, the entire series. And back to the couponing, here's an important note when you're looking at just reoffering yields. A bank can submit the lowest reoffering yields when it's trying to buy a bond issue at every single maturity and still lose, because reoffering yields don't tell you the cost of the debt. It's the yield to maturity, if you want to know the full cost of the debt over time. And we can get even more fancy. I see Andrew Calates in the audience here, and he's done some great work on option pricing and analytics. So as far as valuing the call option, what that's worth and what it isn't worth, you can get as far into the weeds on that as you want to. But the yield to maturity is how bonds are awarded in the competitive market. Very different from the reoffering yield. Real quick, just to hammer home the importance of this coupon here. In today's market, index yields for a AAA borrower at 30 years with a 3% coupon, the reoffering yield is 4.33%, okay? 4.33%. For a single A borrower, okay, AAA rate or single A rated, so several notches below AAA, not even close to the same credit quality, a 5% coupon bond would yield 4.12%, lower than a AAA rated borrower. Very important point. If you're just looking at the reoffering yields. Now, in reality, if you do the full analysis to maturity, that 5%, that larger coupon for the single A rated issuer is going to cost a lot more than the reoffering yield over time, unless those bonds are refunded at some point. So just the reoffering yield itself can really distort analysis. Some closing remarks here as the clock's ticking down. I want to hammer this home as clearly as I can that market efficiency is an important tenet. It's an important idea when you're trying to do empirical analysis, when you're trying to do theoretical work. Markets are not efficient in this space. They're not. They're terribly inefficient in a lot of different ways, comically so sometimes. I can tell you that when you look at negotiated pricings, I can show you examples of the exact same issuer, exact same credit, exact same rating. Everything's the same underlying borrower. Yields can vary by 50 basis points. Same coupon, depending on whether or not that deal, for instance, had an independent municipal advisor serving as a pricing advocate on the deal to help negotiate yields with underwriters. Okay? So, again, very important topic, and I'm out of time, so looking forward to the discussion. Thanks.
Thank you. Igor, I have two questions. One is, so I want to make sure I get your bottom line here. It sounds like you think that this is win-win. It's good for the banks and good for the issuers. Mm-hmm. Is that right?
Yeah, that's right. Yeah, they both benefit, at some point, different points. Kaylin actually mentioned something that I didn't have time to mention. During normal times, we find that actually the spreads for the issuers are actually a little bit higher, which is consistent with that idea that banks are extracting some rent out of the relationship. But then like they stabilize during bad times. So at points, both of them will benefit. Yeah.
You had one bullet point in your slide, and I wonder if you could elaborate on a little bit. What exactly is the limit that the law puts on banks holding tax-exempt issues, and what was the motivation for it? Because you think it's ill-reasoned.
Yeah, so actually this is the topic of a different paper that I presented here when I came for a seminar. Banks used to have what we call like a tax arbitrage on their municipal bond holdings because they were able to they were exempt both from the holdings, from the interest rate that they had, but also the funding, the interest that they paid for the funding was also tax exempt, right? So they could write off of their. But in 1986, the tax reform basically ended that, and all of the interest expenses that they had were disallowed. So now they have to pay taxes on the interest that they have to pay. So they cannot write this off anymore, and that basically almost made the banks disappear from this market, right? So they used to hold 60% of the municipal bonds outstanding. By 1990, they were holding approximately 10%. And now I think that we have mounting evidence that banks are very important, and maybe we want to bring them back to this market because it's going to be beneficial for the issuers, right? So, but yeah. So, but the reason behind it was that it wasn't fair. They were getting too much of a tax break, and in 1986 they basically said, no, we need to make them pay more taxes.
They can't deduct the interest they pay on the.
Oh, exactly. So yeah, the interest payment is disallowed. So it's on, except for issuances from small issuers, which are called bank qualified and only issue at most $10 million per year.
Right. Mm-hmm. Over here. We'll get to you, Andy. Don't worry. I know enough not to ignore you.
Can you
tell us who you are?
Yes, I'm Rebecca Olson from the Securities and Exchange Commission, and Kalen may be better positioned to answer this question, but did you explore at all whether when a bank has a relationship with an issuer, they get better terms? For example, a public bondholder gets annual financial statements. When and if available, a bank might get quarterly financial statements. Do banks get better or stronger covenants? Do they get lower thresholds to event of default triggers? Is that part of maybe why they're getting a better rate?
Yeah, I think this is like where we need to develop the paper more, like right. So I think we have just this yield result towards the end of the paper, but that's something definitely something that we're doing soon. Yeah, but I don't have an answer to that right now.
Yeah, so I think your question would be more relevant to privately placed transactions, which is an increasingly bigger part of our market over the past few years, wherein instead of issuing bonds publicly that trade publicly, an issuer will negotiate with a bank and basically structure what looks like a loan, a bank loan, but they're often called bonds. And what that does is it gives the bank flexibility and negotiating power over the terms of the deal itself. And issuers actually like these, and we do a number of them. They're actually easier to do, especially for small clients. Issuing bonds is a big burden. You got to write an official statement. You've got to have all your staff on hand to review that official statement. It's a lot of work. So having bonds privately placed going directly through banks can relieve some of that burden, but the sacrifice does often yield. You don't get quite the same yield, especially, and that's important for bigger deals where fixed costs are going to be largely overshadowed by the interest rate or the yield on the bond.
Thanks. Gentleman behind you.
Yeah, I love the identification strategy. And
Can you tell us who you are?
I'm Christos. Thanks so much for the paper. There's one of the papers I have with Granja, Yanelis, and Zwick. We use a banking relationship before the PPP to look at how did small businesses perform during the pandemic, and we showed that having a pre-pandemic relationship really mattered for being able to get receipt of the PPP quickly. And so I wanted to kind of ask you about the mechanism that you see during times of crisis, and you have kind of limited variations, so there's only so much that you can say, but it seems like the time to get a deal done matters because these are times of high ambiguity during crisis. And so maybe both of you could speak a little bit about the mechanism behind this asymmetry that you're seeing.
Yeah. So I think that what we're pushing forward here is basically like an information asymmetry story, right? So then if you have a relationship with this bank, they will know more about you and they will know more about your ability to actually react during a crisis. And that's what we believe would be the case. But also there is like this quid pro quo idea, right? That we have some evidence about that, like, like in good times, I extract a little rent from you, but then I'm there for you when you need. And then, like Kalen was saying earlier, right? So I want you to thrive, right? Because you owe me money, I want you to thrive. So then basically there's a little bit of a quid pro quo between like normal times and bad times. So I think that's more or less what we have in mind for these results. You have something?
Andy? I want you to wait for the mic.
Thank you. I wanted to point out a couple of very important things that Kalen said. One of them about the winning bid, which is portfolio. You look at the yield to maturity of a portfolio, completely disregarding option values. And the solution to that is to option adjust the true interest cost. And I suggested this 10 years ago, and I don't understand why it's not being done. That's one point. Then secondly, what you said about comparing low coupon bonds to high coupon bonds. Once again, it gets into optionality. That's what's distorting everything. And without proper option valuation, you cannot make this comparison.
Thanks. I'm going to pass it to Yafa.
Yafa Ratner, Hilltop Securities. Really appreciate the paper and really appreciate the conversation with respect to relationships, the one that we talked about earlier, relationships between underwriters and mutual fund complexes and now between banks. I'm curious if, one of the questions that you weren't able to answer is really the fundamental nuance, like why is City X or Hospital Y going to that particular bank to do the placement. So one question and thought that I would have for you guys is really to reach out perhaps to some of the regionals, see if you can get an NDA in place, and then you could go line by line on some of these credits to really make some observations. Being in the market, I can tell you that generally speaking, just having the bonds is only one part of the revenue source for the bank, right? What they're really looking for is A, the depository relationship, which is going to be the most lucrative, and B, the potentiality for providing additional lines of working capital, which could potentially be done taxable, which is additionally lucrative. So what I would really encourage you to do is really try to figure out what the revenue sources are as they penetrate each client. The second concept is that of difficult times, because the bank has the opportunity, again, to further penetrate the client and make revenues from other sources, their deposits, B, working capital lines, and then finally the bonds. In bad times, they have the ability to charge less because they have the other sources of additional revenue. Last concept is in better times, and I think the comment was made earlier, oftentimes these loans are made without the same covenants that would be done in the traditional market, such as a debt service reserve fund, things like that. And again, if you go line by line, you'll be able to make some very interesting observations with respect to pricing on that. So,
can you pass the mic to Jackie behind you?
Thank you for that paper and all the papers this
Can you
morning.
identify yourself?
My name is Jacqueline Knights. I'm with the Treasury, but I'm speaking on behalf of my prior experience in the banking, finance, and issuer areas in municipal finance. One of the questions I wanted to ask about the paper was, have you given any consideration to the consolidation of the banking industry? There's been tremendous consolidation, and the impact of competitiveness in the municipal industry, and how that affects pricing for the municipal bonds.
Yeah, we have not, but that's a great point. So I don't know if our time series is long enough for us to do that, but that's a great point. And I think we're looking more on the perspective of the bank and not so much on the perspective of the issuer, because that's our strength here, because we have data that was not available to the literature before, right? But going back to some of the other points, thank you very much for all the points. We're going to go back to all of them and review all of that, especially the point about the other sources of gains for banks. Right now, we're just looking at returns, but we do have data that will allow us to look at more ways that banks can gain, and we hope to find something. But yeah, I'll review the video after we're done here, and I'm going to go over all of your points very carefully. Thank you so much. I really appreciate it.
Yep. Excellent point. I just want to add, you're right. With respect to the, not necessarily even the consolidation, but we've got banks, big banks exiting the muni space, UBS, and then most recently Citi. That's huge. And it's not good for the industry when competition leaves. So I don't know.
Why are they leaving?
It wasn't profitable.
Good reason.
Or profitable enough. So.
Thanks. So I'm going to invite Christine Cooney from NYU Stern, who's going to moderate the next session.
On. A fellow at Stanford, thank you, and also an associate professor at Arizona State. This will be followed by a discussion by Yafa Ratner, who's the head of municipal credit at Hilltop Securities. The title of the paper is Markup or Markdown, National Underwriters Exit, and the Changing Landscape of Municipal Finance. The floor is yours.
Awesome. Thank you so much. We're really grateful to the organizers. And I mean, I have to say we didn't even have to bribe anyone to ask all these questions beforehand to set up our paper perfectly. This is joint work with Zhang, John Hund, who is watching, and Christian Lundland, who's also here in the audience. And we're really excited to share this with you. So the motivation for this paper really doesn't require that much, especially on day 2 and after all these questions that have been asked about entry and exit in the marketplace. Namely, we've seen these big underwriters leave, and there's a lot of questions about what the future of municipal finance is going to look like without these larger underwriters here. So this paper is going to be studying, of course, the muni bond market. We're going to be focusing in on these recent exits, but we're going to take a very historical perspective. We're going to go back to 2005 and look onwards and see how has profitability in this sector changed, and how has it changed for larger versus smaller underwriters. There's a lot of different explanations, and we're grateful that there's folks in the audience like Dan and Yvonne, who was here yesterday, that have contributed to studying the market microstructure of muni finance. We're going to take this very seriously and go back in time to 2005 and try to structurally quantify how markups among underwriters have changed. And so we're going to have some reduced form evidence, and then we're going to have a model that takes this even more seriously. So in a nutshell, this is what our paper is going to do in one slide in case anyone gets bored and wants to get some more food outside. So we're going to be drawing on the Mergent, MSRB, STC Platinum, and Bloomberg data. One of the very unique aspects, and I'm just so grateful to Zhang and to John for combing through this data set, is because to get markups, as we know from the first presentation today, it's not easy. There's a lot of censored data, and so they were able to harmonize these data sets. And so for every bond, we're able to compute markups on it. We take a model from Richard Green. So Richard Green had a presidential address in 2007 where he was studying and delineated between informed and uninformed traders. And so we're going to bring about 20 years of data to this model, and he kind of visioned a world where there's competition in a Bertrand format, and there's price dispersion that emerges due to limited price transparency. And because we have so many years in our data set, we're able to exploit some of these natural experiments with what the SEC has done to bring about more transparency in the market. So what do we find? We find that there's been an increase in institutionalization, so an increase in maturity of this market, increase in transparency. There's been large declines in markups and declines in profitability, like what was just mentioned. And as Callan kind of quoted the memo from Citi, they basically said it's no longer profitable for us, and so they left. There's also been a decline in encountering uninformed investors. So you kind of have a double whammy where there's been a decline in the share of uninformed investors, but there's also a decline in markups concentrated among uninformed investors. And so what does all this mean? Well, we think kind of interpret it as these recent exits might reflect this decline in profitability more than anything else. And so the story isn't over for the muni market. I mean, every market has ups and downs. And so it could be that people come back in 5 years from now. Maybe they decide that it becomes profitable due to these changing dynamics. So for sake of time, I'm not going to go too much into the theoretical model from Green. All I want to flag is that that Richard kind of specifies a strategic interaction among issuers, underwriters, investors in a Bertrand sort of format. Skipping ahead. So yeah, there's basically a theoretical model anchoring this. And I really love John made a comment. He was like, this was written perfectly for us because no one, like this model that Green wrote in 2007, this didn't have that much data at the time. And now we have decades of data. So anyways, these are the data sources, already mentioned it. We observe a wide array of information about the underlying bond, so we're able to control for a bunch of potentially confounding factors. We observe, of course, when it was, so all the dates, and then crucially to our paper is that we're able to compute the markup. So the difference between the customer purchase price and the offering price, we express this as a percentage of the offering price, and then we use trade size weighted average markups for these. Sample period 2005 to 23, a little bit of information about them. So we observe a lot of trades. One of the key results is that national underwriters are accounting for the bulk of the volume, but smaller and small regional single state underwriters account for about 20%. It's declined a little bit, and then larger national and large regional have grown over time. Let me skip that. And I'm just going to focus on visuals. So You can see here, I mean, I guess maybe you have to squint a little bit based on where you are in the audience, but so national has been growing over time. So you can see in the top plot, this is just number of deals, and then bottom plot is underwriting volume. And so there has been this increase over the past 20 years. Same with large regional has been increasing. Similar trends when you look at underwriting volume. So now reduced form evidence, because we have a bunch of visuals that show that national underwriters have grown, and then we compute markups. But let's take this to a regression format, because there's a lot of confounding effects, and you don't want to we don't want to be worried about omitted variables. So we regress markups on year fixed effects, the deltas. We're going to plot the deltas so you can just see average markups over time. But then the critical interaction effect is this beta 1 and beta 2. So this beta 2 is going to tell us how has markups changed for national underwriters over time. And then we're going to control for a lot of characteristics about the underlying bond. And so this is what, so the first plot is what you see, just raw data. So the raw data, the key lines here, the purple, so that's showing that big decline in markups for national. There were questions about what are the exact markups, and so the y-axis shows you in basis points. So going from around 20 to under 10, about 5 basis points. Single state is kind of an exception. Single state are really small underwriters that really just focus, as the definition says, on a single state. But for small regional, large regional, national, they've been declining. And so then that was the unconditional correlation, the raw data. What does the conditional correlation, that beta 2, tell us? And so the key plot here is on the bottom. And so this is plotting those interaction fixed effects between national and year. And you can see that there has been this sustained decline in markups for national underwriters. We can do the same thing looking at underwriting spreads, and the one thing I want to note here is that, and yesterday we heard about some of the reforms as well the SEC has done around disclosing markups, and so we're going to exploit some of that policy variation and find kind of consistent with what's been spoken about already that this has contributed to declines in markups. So this is just in tabular format. Top left is just showing when you pool all bonds together in the most saturated specification where we put on all these different fixed effects, state fixed effects, all the controls, et cetera. You find this decline in markup. You find that it's concentrated in go bonds. You can do the same for underwriting spreads, and we also show that there's been this increase in maturity in the market, an increase in the level of institutional trades that are going on overall, but especially among large regional and national underwriters. Bottom plot here is just showing a different outcome variable. It's plotting the interaction effect between national and year for underwriting spreads, and showing that there's been this decline as well. So when we revisit the green model, and I don't want to lie and say I'm going to go a lot of detail into this model, but I do want to specify a little bit because a big challenge in the space is that there's such heterogeneous, there's a lot of heterogeneity around investors. And we talked a little bit before about going to people that you have relationships with, and to what extent are investors informed versus uninformed. And so in this model, there's two classes of investors, the informed and uninformed. And the investor becomes informed if the benefits exceed the cost. And so the way the green model this was as a latent variable. It's not like we get the Bloomberg data and we just see, oh, here's a binary variable indicating whether this person's informed. It has to be estimated, and so we estimate it using bond characteristics, some markups, and so anything that's above Z star going to be informed, and below Z star is going to be uninformed, and so this again is disciplined by the data. And so headline results from this, and then I'll show you the visuals, is that we find that there's been a steady decrease from 55% of uninformed trades to about 25%. So there's been a big decline in the share of uninformed trades. And then we also see that there's been a decline in markups among uninformed investors. And that's what that double whammy effect of decline in uninformed investors, but also a decline in markups among them. So there's been this increased proportion of informed traders. National underwriters are also less likely to trade with uninformed investors over time, lower markups on uninformed trades compared to the regional underwriters. This is just a visual showing that rapid decline in uninformed trades, and markups on uninformed trades also declined, and national underwriters and the probability of dealing with an uninformed trader. Similar on spreads, dealing with spreads, it's just kind of going in the opposite direction here. There was a really, I didn't pay Dan to say this, but when he was talking about money left on the table. So there's this concept of when you're doing underwriting, how much money is left on the table. And so because we compute these latent variables of who is informed versus uninformed, conditional on dealing with an uninformed trader, how much money is kind of left up for grabs on the table. And so we compute this over time. We show that it increased during it kind of went up during the financial crisis and then started going back down. And so we, again, interpret this as additional evidence that market transparency has led to kind of increased competition in the market. So now where I want to land the plane in the last 3 minutes is trying to think about what does all this mean? Because again, decline in markups, it seems robust. The reduced form evidence, we take it to a model. What does this mean going forward? So we've had these recent exits. There's natural concerns about what does this mean about kind of competition in the space, and is it going to increase yields? Is it going to lead to increased markups? And in one sense, this is kind of like the market working. I mean, people have the choice to exit if it's not profitable for them, and they make that decision, and then there might be future entry. And then, yeah, there could be information asymmetry around these intermediary relationships. But let me get to what we do. So we exploit as a natural experiment Texas's legislation, which prohibited interaction with some of these financial institutions, and so sometimes this has been a argument for why there has potential negative effects on the market, and so we want to take this seriously. And so we study this Texas bill, and we do a treatment and control sort of setup where we look at we take as a control group the states that have a similar low tax environment, and we non-parametrically match based off of bond type, offering type, rating maturity, et cetera. And so we're going to use this non-parametric matching approach to try to get at was there effect on yields and on markups. And so we find no effect on yields, and we find some slight evidence of an increase in markups. And so this is the table that summarizes this. So the key is panel B and panel C. Panel B is showing during the policy period that there's not much evidence of an effect on, there's no statistically significant difference in offer and yields. There's a slight increase in markups. On the after policy period, that there is an increase in markups, but not on yields. And so we kind of interpret this as, yes, there were major underwriters that left the market, but it doesn't seem to have substantially changed yields, but time will tell how the market continues to evolve. So let me wrap up just with this slide by kind of recapping that national underwriters really have dominated this market, and large regional as well, in terms of quantity value of deals. But there has been this declining markup among the national and large regional. We find that there's been this institutionalization, this increased maturity in the market. So the market maybe is kind of working as it should. And even going back to Brad's remarks yesterday and the contributions that he's made actually as a pioneer in this field, there has been a lot more transparency and the use of technology to be able to not just like call up a buddy and say, can you get me a deal, but actually being able to see all these trades electronically. And so lots of future directions that we could take. I mean, for starters, we want to track how markups continue to evolve, whether the sector does remain competitive or whether there is an effect on yields. And then also we're kind of interested in the role that technology will continue to play. I have to mention the word blockchain here somewhere. And so how might being able to put trades on chain, maybe will that affect competition? But really looking forward to the discussion. Thank you, Yafa, in advance for your comments and for bearing through the paper and reading it. And so with that, let me wrap up, and excited to continue the conversation.
Good morning. I'm Yafa Ratner. I am head of credit at Hilltop Securities, and I thank you for the opportunity to respond to the paper. I do think that there were some very good points that were made in the paper. However, I do think that there were some comments that were made in the paper that, from a market context, I wouldn't quite agree with. So What I'd like to do is maybe take a couple minutes and set the stage for the exits of UBS and Citi and some of the comments that you made in the paper, and then actually look to some of the specific comments in the paper and talk about where we agree and maybe where we don't quite agree. So what you see here is just the trend in annual volume. You could see that the market peaked in 2021 at about $450 billion. 2022 comes, market drops by about 20%, really attributing that to fears of a recession, increasing interest rates, and very significant outflows from the mutual fund complexes. What we see here now is the average spread that we're seeing. There's been a lot of conversation about spread and how it has declined over the last 20 years. Completely agree with that, but don't lose sight that there are some weird peaks and valleys here. Look at 2021 in specific, increased volatility when COVID came, and spreads actually increased. In addition, what we also saw in 2021 was the apex of the high yield market having deals successfully launched. High yield, meaning non-rated or low BBB type credits. Spreads on those deals are higher because they're more challenging. There's less certainty of execution. So just be aware that there can be, although directionally they're definitely heading down, but there can be periods of increased fees. And by the way, all of this data is from Bloomberg. What I do now is just take a look at how the par value or par volume of issuance in the primary coupled with the average or the weighted average of the fees, what does that do to new issuance revenue on a whole? And you're pointing out the difference between 21 and 2022 is not only did the market drop by 20%, actually the revenues dropped by about 25%, which takes into consideration two facts: one, volume decline, and then two, fee decline. So what is this ultimately telling us? So one of the comments that you make in the paper is that losing access to the Texas market in the case of Citi and UBS probably didn't, in and of itself catapult them out of the business. And we completely agree. And what we would posit, and perhaps you might want to spend a little bit of focus on, is taking a look at how much municipal revenues for each of these firms meant to their overall revenues. So, for example, if you do the math backwards, Citi probably generated about $100 million in annual revenues from primary municipal bond issuance. I looked at their 23 annual report. They generate about $75 billion in total annual revenues. So basically, municipal revenues were basically less than 1% or of their total revenues, and therefore, given how quickly the revenues fell apart within the muni space, and more likely than not, how quickly they could not respond to the changing expenses, they left the market. And the similar construct would be held constant for UBS too. What I show here is, I think it's interesting, this is Texas as a percentage of all of state issuance in the municipal market. You could see that the top 4 states are about 30%, and Texas being about 10%. This is just the importance of Texas to Citi and UBS. Note the difference on the y-axis with Citi obviously being significantly larger than UBS. Okay, here's where we start to disagree a little bit with respect to the paper. One is the concept of informed versus uninformed, and what we'll say is retail versus institutional. In the primary market, underwriters are charged with making a public offering at a stated offering price. We do not mark up bonds. And I think some of this actually, as I'm listening to the context of the conversations that we've been having in the earlier papers, I do think there may be some confusion into what is primary market versus what is secondary market. If I come in and I purchase the bonds from you, that's a primary market issuance. If those bonds then trade up, and they flip to another buyer or another one, perhaps because of relationships, because of not, that's secondary. And you've got to be really careful between your references to primary market issuance and secondary market issuance. And it's come up a number of times in the paper. The other thing that I really suggest that you really focus on is on the concept of fees, both as it relates to national, regional, and state underwriters. And the concept here is that there's an inevitable push-pull behind or between the largest underwriters and how low they want to take their fees to remain number one on the league table. So, for example, and again, Bloomberg information, Bank of America number one, their average fee is about $3 a bond. Conversely, and we look at the next slide, RBC, which is number two with about 10% of the market, their average fees are closer to $5 a bond. So what's happening here is Bank of America, with 15% of the market share, is actually making about a third less than RBC with about 10% of the market share because of this whole concept of how much are they willing to charge or how little are they willing to charge to maintain that number one league position. And the concept here is if I'm number one, I'm going to make up in volume what I've lost in fees. And I'm not sure that that's quite true. What I do put on the right side is where Citi and UBS were in terms of new issue revenue by firm. And keep in mind that Citi at their apex was literally the number two underwriter in our space. Now add in JP Morgan, their average price per bond is about $4 a bond. They're similarly sized to RBC, but you could see, despite the volume, you could see what their revenues are looking like because of where they're trying to get in the league tables. And I caution you in your paper to really think about that, because it's really not so much a function of are you a state, regional, or national. It's where do you want to be in the league tables, and as a secondary item that you really need to focus on is what is the composition of the transactions that you're underwriting. And I'll show you in a few minutes that those firms that focus on more challenging transactions, perhaps senior living or land secured transactions where there could be higher rates of default, they are charging more because there's less certainty of execution and those markets are much more volatile. And this brings me to the 2 points that perhaps I disagree with most in the paper is that national underwriters tend to charge lower underwriting spreads to issuers. And then the second concept is underwriting fees are negatively correlated with risk and volatility in the muni market. And these are direct quotes from the paper. So as we saw in the prior slide, it's not only a function of charging less because we're going to a broader market, right? We're going to a national market. Take a look at where they want to be in the league tables and take a look at the quality of what you're actually underwriting, which brings me to the last slide, which I wanted to share here. Piper Sandler, which is a firm that I worked for 14 years and was their chief credit officer, is a top 10 firm. And yet their average price per bond, again, this is Bloomberg information, was in the $6 to $7 ratio, which was more than double that of Bank of America. Is it because they're not a national firm? No. I would posit that they're doing, plenty of national credits, but they also have a sizable portfolio of transactions in the healthcare, charter school, land secured space, all of which have more risk, more volatility, and they get higher compensation for. FMS and MBS securities, if you look at the left, those are firms that are really, really strong in the land secured space. There's data that will show that by absolute numbers, not necessarily volume, the largest number of defaults in the muni space are in land secured. And it's not a surprise that you're seeing FMS and MBS, which is almost exclusively land secured issuance, are getting the highest price per bond. On the other side of the spectrum, let's say, for example, Ziegler, top 20 to top 30 type firm, they're focused predominantly in senior living. They're also getting a pretty high level of a fee per bond. Senior living is the number 2 area of default, so you're seeing that inherent correlation. So it's not negatively correlated, it's actually positively correlated. Similarly, D.A. Davidson has a pretty significant amount of high yield credit, land secured, charter schools, senior living to a lesser degree, and you're seeing high rates of fees here. So just really be careful in terms of the correlation And the second concept is really be careful in terms of, because the goal is not national versus regional, it's really where in the market you want to sit. And those are my comments back to you on a good paper.
Okay, thank you to both of you. Christos, I just want to give you a chance to respond if you'd like to begin here.
Yeah, well, thanks so much for reading. Yeah, I'd be happy. Maybe spend more of the time just opening it up for Q&A. I think, yeah. So a couple of notes I wrote down was so we're controlling for a lot of these composition effects. So there's a lot of heterogeneity in the type of bond, the amount, the credit rating, et cetera. And so we're trying to difference out a lot of these composition effects. So some of the examples you were giving about the types of senior adjusted living, et cetera. I think we're controlling for a lot of these factors. But yeah, maybe, yeah, we could go into more detail, but also
Great,
want to
yeah.
leave it open.
So why don't we take some questions then? Yes, please.
Regarding that the last slide that you showed, Yafa, I'm sorry. It was interesting because you're saying that the lesser rated, more volatile credits that are subject to default are generating higher revenues for underwriters, right? And that begs the question, is there sufficient due diligence being done on these offerings? I know the big banks would likely not take those on because they have so much reputational risk associated with it. Can you comment on whether or not there was any, or maybe the paper, are those fees justified given the outcomes, and that the fact that the underwriter, what are the risks to the underwriter after the bonds are sold?
So I think we're moving the field from the paper, but happy to...
Keep the mic on.
Thank you, guys. I think we're moving a little bit afield from the paper, and happy to take this on a one-on-one discussion with you. Having said that, there is the bifurcation, if you will, between the investment grade and the strongly investment grade space and the high yield space that's in the market, right? And as you go from triple B even to double B, it doesn't mean that the rating agencies expect that there would be a default, right? It's just the margins of profitability or margins of financial cushion become more compromised. As you move into the high yield space, there will be more defaults. And the question that one would want to ask to an underwriter as well as to an investor, are appropriate investor protections in place in those documents? Are those documents fairly outlining the risks associated with a particular transaction? Are they easily and readily transferable, and are the minimum denoms on those transactions appropriate? So if you have a high yield transaction, are you allowing somebody to come and buy, a grandmother to buy one bond at a $5,000 denomination, or are you saying, no, the minimum purchase has to be $100,000 or $200,000? So there's a lot of pieces that go on as to whether or not the right risks and protections are there for an investor, but I don't think that that's the point of the paper.
Other questions?
Dan Bergstresser, Brandeis. I just want a clarification question. What I understand the paper to be focusing on is the difference between the offering price and the price in the post-issuance subsequent trading, which I think Yafa, you would call that the secondary market. You would call it kind of the primary market because it's happening in the first 14 days. But that is your measure, is what's happening between the offering price and then what happens in the post-issuance kind of trading in that first 14 days. Yafa, your exhibit, which I thought were really interesting, what you're showing there is the gross underwriting spread. Is that like will be in the official statement, like you'd say, the offering price.
The price per bond.
So the price per bond, the official the gross underwriting spread, which is actually sort of a different, the total that put together is the difference between what the issuer gets and what the eventual customers who purchase it end up paying, but they're different slices of.
Sure, and I would even posit that there's an additional slice, right? The cost of issuance as well. That would also include counsel, survey, any kind of professional reports, things like that. So, you could, there's lots of different slices to the puzzle. What the paper is saying, and where I completely agree, is that the fee per bond, no matter how you look at it, has certainly come down over the last, let's call it 20 years. And could it be a function of greater informed investors? Could it be a function of greater transparency? I would posit they're both correct. However, what I would similarly suggest is that just be careful, because as you go through the years, you're going to see a couple of peaks and valleys that will reflect certain idiosyncrasies that could be macro or micro, and you might want to think about it. I also agree with you that my definition of the primary market is different than his definition of the primary market, and that's okay. But the point is, you need to just add some more language to help the reader understand that, the primary market as defined by the trades that will happen in the first 14 weeks post-issuance. Excuse me, not 14 weeks, 14 days post-issuance.
Okay, there's a question in the back.
Hi, I have two questions, actually. One, on the paper, there was a slide about money left on the table, and this is somewhat related to this. Could you break that down a little bit? I mean, is that primary issuance, meaning either inefficient pricing or just trading on the break? Or if it includes a secondary, that's just bond trading. And then the second question is for, in the response, it's more of a comment that I'm surprised that the largest underwriters are able to, there aren't a lot of large underwriters who charge $4 and $5 a bond, so I'm surprised that they can make up enough transactions to be a number 1 or 2 or 3 rated underwriter and still average out at $4 or $5 a bond.
Yeah, thank you. Let me start with the second point first. And so this also goes to a question around how we're defining the different types of underwriters. So national is, I think the cutoff was something like 44, at least in 44 states. And then we have large regional, and it's another threshold. And so one question is, I mean, how much variation is there within groups? Are people exiting and entering? And so in general, most underwriters stay within that group, and we've done some robustness around the threshold. The reason why that's relevant is because of the question of, can they actually make enough money? And so when you're dealing with that many states and you have that much volume, and you can have kind of we get to a low markup in the later part of the period where it's profitable, but up until a point, and that's maybe why some underwriters exit. So I don't know if that answers that second comment fully, but that's maybe a little bit more color there. On the first part about MLOT, money left on the table, so Dan set this up a little bit earlier, but the way that we define it is when we compute these latent classes of informed and uninformed investors based off of markups in these bond characteristics, they would condition on trading with a uninformed investor, and we compute the difference between uninformed and informed. And so this sort of represents the amount of value, the amount of surplus that is able to be scraped up because you're dealing with somebody that is that's a less informed trader, and so there's more producer value, there's more surplus that can be kind of scraped up. And so the fact that it kind of came back down was consistent with this kind of growth in competition, growth in transparency. Does that answer it fully, or do you want to have a clarification on any of that?
So basically, it's the difference. So basically, you're saying, because earlier somebody pointed out that what you're really probably, I think, talking about is institutional versus retail buyers. And you're saying that the money, the markup to retail buyers from institutional sellers is coming down.
Yeah, so this may be a good clarification, Jang, if you want to jump in as well. But yeah, so there is an increase in the share of institutional, but you can be across specifications. You see an increase in institutionalization. So yes, retail it seems to be going down, but I think in our model we can. I think its share of uninformed has gone down. but that's true across the board. So it's not necessarily just retail, if I remember right. But yeah, we can talk after the break around that.
I would actually encourage another analysis to be done, and I was thinking about this, and actually we were talking a bit about it internally as well, is that there is this relationship, right, with the national underwriters, the largest underwriters, that the race to the bottom, we call it, right? They want to lower the fees, get the most volume, and hopefully, trade off the volume and profitability by getting more deals in the house. But I would challenge you to maybe take a look at those transactions with the lowest price per bond, which often then results in, maybe wider pricing in the market. Basically, doesn't result in the highest or the best interest rate for the client, because that particular underwriter doesn't want to take anything on their balance sheet. They don't want to take any risk because they just got paid $3 a bond. So I would posit that to your analysis of money left on the table, I would wonder if that number would be higher the lower the underwriting spread is, that there's an inverse relationship there, that pricing can be wider when underwriters are not being fairly compensated because they don't want to take any risk when there's relatively lower profitability.
Yeah, no, it's a great point. I mean, this kind of is reflective in any professional services. Sometimes you pay a markup because you want to get premium services. So it certainly could be the case. And that's why, maybe markups shouldn't be zero. Maybe they should be some kind of positive amount where they're able to get more premium services. So all that we're saying in the paper is that there does seem to be this sustained decline and that there are these ups and downs, but trend line is a decline, and no matter how you cut the data. But no, well taken.
Great. All right, I think we have to leave it there. You can take more questions offline. So the next paper is going to look at mergers and acquisitions. Yeah. The next paper we have is going to look at mergers and acquisitions. So it's going to be presented by Renping Lee, who's a doctoral student at WashU. And then it'll be discussed by Peter Iliev, who is a professor at Penn State.
Hello. Okay. Hello, everybody. Before I start, I would like to give my thanks to the conference organizer and also my discussant. And so this paper is about mergers and acquisitions, and it's also about security issuance. And we all know that security issuance is a pillar of the financial system. And in the U.S. in 2022, the amount of new issuance of municipal bond amounts to $410 billion. And one thing we're curious about is, has the security issuance reached its full potential in terms of serving the real economy, which is here the whole governments? And we think it might not be the case, and maybe there can be some inefficiencies in the underwriting process. And we can look at this news report from Investigate Midwest. And it says that some issuers, school districts, they can easily be taken advantage of and urged to issue needless or poorly structured bonds, or pushed to accept high interest rates, or duped into paying hundreds of thousands of unreasonable fees. Thank you. And so the question is, how should we view these underwriting fees? Is it that the underwriters, they are rightfully compensated because they are using their skills and they are taking significant risk? Or is it that the underwriters, they have market power and they are earning economic profits? And if it is the latter case, then it could be that the level of issuance in the economy can be below the optimal level. And to study underwriters' market power, an instinctive strategy is to use M&As as a shifter of market power. And the municipal bond market is ideal for studying this, first because it's highly geographically fragmented, especially in earlier periods of our sample. So for example, if there's some consolidating activities in the East Coast, then we can use the West Coast, which does not have consolidating activities, as a control group. And also it's a dynamic industry with lots of M&A activities that we can make use of. So I ask this question in this paper. First, do M&As between municipal bond underwriters lead to higher underwriting spread? And second, if this is the case, can this increased spread be interpreted as these underwriters, they have market power? And third, do these M&As create some efficiency gains that can potentially benefit issuers and offset the rise in the underwriting spread? And fourth, do the local governments have worse financial health after the M&As? And now I want to convince you why this question is important, and I know that it's a difficult thing to do because we just heard the last wonderful presentation about how this underwriting spread has been declining and is quite low now. So the way I think about it is, first, of course, our findings are not at conflict with each other. The message I have is, if there wasn't these consolidating activities, then the underwriting spread would be even lower than what it is now. So compared to that hypothetical counterfactual, I'm seeing that the underwriting spread is excessively high and also has some policy implications. For example, the president has shown support for major bank antitrust reforms, and one major aspect is to heighten the scrutiny of M&A deals, and research has shown that bank mergers that is between commercial banks that do deposit taking and lending activities, this can have negative effects on the borrowers, but people have neglected the investment banking activities in these bank antitrust regulations, and this is the first paper that studied M&As of investment banks. So for the data I use the SDC data, and I hand collect a sample of M&As between municipal bond underwriters and also complemented with these two standard M&A databases, and I found a total of 2,056 M&A deals. Among these, 160 have geographic overlaps in that they operate in the same areas. And my first finding is that the municipal bond underwriting market is much more geographically fragmented compared to corporate securities underwriting. For example, if we look at the top 10 underwriters in the past 10 years in the states of Massachusetts and California, we can see that none of the top 3 in California is the top 10 in Massachusetts and not the other way around. And there are a few reasons for this highly fragmented form, and I think the audience here, we are all familiar with this. And now I'll talk about how I make use of these M&As. So first, I define a market to be a CSA, which is kind of a default geographic partition used by the Census Bureau. And what I do is I look at how much an area is affected by an M&A. And for this, first I calculate the HHI based on the market share of underwriters before the M&A, and also calculate the predicted HHI if I combine the market share of underwriters that engage in M&A, and then I calculate the difference, which is the predicted increase in HHI because of the M&A. And I see that an area is affected by M&A if this M&A leads to a bigger than 100 increase in the HHI of this local market. So for example, here I plot the market share of 2 underwriters, SunTrust Bank and Equitable Securities, and we can see that these Equitable Securities, they operate in several areas in the state of Tennessee, but this SunTrust Bank, they have more spread out businesses, and when these 2 firms merge, these 2 areas in Tennessee will be affected by the M&A, so they will be treated. And for each treated area, I look for a control area that is more similar in terms of population and average income per capita. And then I pull the bond issues in treated and control areas. And then I have a stacked sample, and then I do a diff in diff. So here I have issuer fixed effect and calendar year fixed effects. And before I show you the results of this regression, I want to mention that theoretically, the direction of the effect is not really clear ex ante. So one can see that M&As can bolster market power and lead to higher underwriting spread, but also, on the other hand, M&As could create synergies and lower the marginal cost of providing underwriting services, which could lower the underwriting spreads, so it can go either way. And what I found is M&As indeed is followed by a higher underwriting spread, so the magnitude is 5.3 basis points from a sample mean of about 100 basis points. And the effects hold if I use other threshold in terms of how much an area is affected by M&A. And here are the dynamics. We can see there's no pre-trend, there's a sharp increase in the year of M&A, and it does not seem to reverse over time. And here are some cross-sectional heterogeneity. So we can see that the effects are stronger for more significant deals that lead to a higher predicted increase in HHI. And the effects are stronger in areas that were already concentrated before the M&A. And the effects are also stronger when the issuer is not using a financial advisor. And all of these are consistent with these M&As lead to bigger market power, which translates into higher underwriting spread. And now I'll talk about how I address the endogeneity concerns. So the main concern is there might be some local economic dynamics that drive both the M&As and the underwriting spread. So the first thing I do is I read through the news reports for these M&A deals and I categorize them into these categories. So we can see that one can argue that the acquirer's desire to gain local or regional dominance or the acquirer's desire to expand geographically, this could correlate with local economic dynamics, but it's hard to argue why the acquirer's desire to gain industry-wide dominance or synergy from combining different lines of business, how this could be correlated with local economy dynamics. It looks more like something that is orthogonal to the local economy. So what I do is I exclude all cases where I cannot find the rationale for the M&A, and also I exclude cases where it looks like something that could correlate with local economy. So I exclude 2 of them in column 1 and 3 in column 2, and find the effects still hold. And the second thing I do is I consider only these scenarios where the M&A affected area account for a very small fraction of the total businesses of the merging underwriters. So the argument here is, given that these areas are so insignificant for the merging underwriters, it's less likely that these areas are driving these M&As and I still find an effect. And these 2 findings make me more confident that indeed the M&As are leading to a higher underwriting spread. And also do a couple placebo tests, and I found there's no effect if it's a cross-market M&A where there's no market overlap, and there's no effect for purely commercial bank M&A or withdrawn M&A. And this saying that in places where there shouldn't be an effect, there indeed isn't. And now I take a look at the offering terms. So I first look at the offering yield and also the yield spread relative to the treasury securities. And I do not see any effect on average in either direction. And then I look at initial underpricing. I see there's a small increase and a small drop in the frequency of the bond having callable features. So this higher underpricing and less use of callable features, they are costly for the issuers, but they might benefit the underwriters because now these bonds can be more attractive to the investors. So based on these findings, I can see that there is some evidence that maybe the more powerful underwriters, they are also influencing the offering terms in directions that benefit themselves but hurt the issuers. And I also take a more detailed look into whether there are other kinds of efficiency gains that might benefit the issuers. So my hypothesis is after the M&As, the underwriters become more efficient and they become better at marketing and distributing the securities. So maybe now the same securities can be marketed and distributed without having bond insurance or credit ratings. So in other words, maybe the more efficient underwriters are somehow substituting for bond insurance and credit ratings. And another hypothesis I have is maybe through the M&As, the underwriters, they gain some expertise that usually reside in the domain of financial advisors, and now they become more efficient. That reduces the reliance of issuers on the financial advisors. And so my story is maybe after the M&As, the underwriters become more efficient and they, despite paying more in the underwriting spread, they are incurring less cost on these 3 aspects. And here is what I found. I found that after M&As, indeed, there's a drop in the frequency of the bond issuer using credit ratings or insurance or financial advisors. Although the magnitudes are small, they are in the range of 1% to 2%. And now I check if this drop in other costs is enough to offset the rise in the underwriting spread. So what I do is I construct the total issuing cost, which is the sum of the underwriting spread, the credit rating fee, bond insurance fee, and also the financial advisor fee. And what I found is these other fees, the drop in the other three kinds of fees are too small to offset the rise in the underwriting spread, and the total issuing cost that the issuer pays is still going up after the M&As. And in the remaining time I have, I'll talk about some of my findings from the local government financial survey. So the data I use is from Census Bureau, and there are two motivations for using this data and do this exercise. One thing is I want to validate my findings from security issuance outcomes. Another motivation is I want to fully quantify the effects of M&As on local government's financial health. And one reason is that there can be other complex features of the bond issuance that I'm not capturing, and there can be also potential indirect effects from local government fiscal multipliers. So that's why I feel like looking at it from the government side can provide new insight. And here are my findings. I found that after the M&As, in areas that are affected by M&As, the local governments, they are paying more in terms of the interest cost, and they are also cutting their amount of new issuance. And when we look at their budget surplus ratio, we can see that it goes to the negative direction by about 1 percentage point. And if I convert this into dollar amount, annually a median county impacted by consolidation, they incur 0.15 million more in interest payment and cut new issuance by $1.06 million. So we can see that based on this, the local government's financial health worsens after the consolidation of underwriters. And let me conclude here. So first, I found that the underwriting spread for municipal bond rises after M&As of underwriters, and the results are consistent with the market power explanation. And despite some evidence of efficiency gains, these are too small to offset the rise in the underwriting spread. And finally, my research provides a novel perspective on bank antitrust regulation, which usually focuses on deposit-taking and lending activities, but neglects investment banking activities. So that's all. Thank you.
All right. So thank you very much for having me here. I kind of learned a lot from this conference and keep learning. I'm going to give my comments, but I'm kind of a professor, which means I really look forward to how practitioners think about what's happening here. Okay? And I was quite excited about this paper because it's kind of interesting. The big picture for me is we all know, and you guys do know, that intermediaries are crucial in almost any market. But when I think about the muni market, I think that this must be even more important because then you connect, you place. There's a lot of uncertainty here. Now, intermediaries kind of charge very high fees in many other markets. They've been studied a lot in finance, and they charge up to like 6% in IPOs, real estate. All right. Now, what this paper is doing tries to look at the municipal bond market underwriters, and it has a very focused question. It's what's the role of underwriters? And in particular, what happens when underwriter concentration increases? And would this kind of affect issuance and fees? All right. Now, you can just kind of regress. You can just regress fees on some measure of concentration, but the paper is kind of more sophisticated. let's use like a shock here. And the shock is going to be M&A deals, like two underwriters merge, and I get a shock. So the paper's kind of well done. Oops, my picture looks kind of bad, but paper's well done and has really cool pictures, which I tried to borrow, but kind of unsuccessful. At the end of the day, what you have here is two banks merging, and both of them operate in this market. So we're going to pick another kind of, let's call it random, but not random, similar market far away, and use like a standard diff and diff approach, see what's happening. Once they hold more of the market, would they charge higher fees, right? So that's kind of the question. Now, main results, 5 basis point increase in fees relative to 103 average. And I shall apologize, this is 1 percentage points increase in government budget surplus and property tax. So this is kind of cool. Not only get the fees to increase, but have real effects. So that's kind of a real cool, and it has policy relevance. In fact, the whole paper is kind of written with the policy relevance in mind, which is awesome. It pretty much says, do investment banks possess market power, and does their concentration have anti-competitive effects? And the paper says, yeah, yes. So I think now I think the paper's cool. The execution's kind of immaculate of what's been done. A lot of things done, a lot of robustness checks. But once you make kind of policy prescriptions, the burden gets high. Because this not only implies causality, but it also implies who should act on this. Like if there's competitive effects, already I got President Biden there, he should kind of step in. He has other problems too, but maybe he's on top on that. All right, so I'm going to hammer a little bit here on the identification, and Rimpin knows about that. It's in my slides. But I think the setting's cool, the data is cool, the correlations are great, something's happening, I'm going to learn more about it. And the paper is going to get better. All right, so, and it's a practitioners conference, so I start with industry trends. I wish I had league tables, but I don't. And here's how deep my research goes. I found this article in Bloomberg, 2021, and it pretty much saying like fees in a race to the bottom. So fees here were $20. I was like, $20 of what? So $20 means $20 fees for 1,000 issuance, 2% in 1980s. I wish I was in one of these banks back there, okay? And then these fees have gone down to not only like $5, which is, I guess, half a percent, 50 basis points, but down to almost like the banks begging and saying like we do it for 50 cents on $1,000. So the big banks, these are the national banks, saying we just do it for free for you, kind of. I mean, so the fees are collapsing. And we saw this in the previous paper. The guys we're talking about are going to be pretty much this small and large regional guys. And they're under a lot of pressure to get these markups down, which is one way they make profits, as far as I know. So they're under pressure. And they're kind of disappearing. You see down up there, they're disappearing. I mean, there's a lot of kind of exit from this market. And we got the Citibank and UBS kind of exit. I actually thought the paper was going to be about this. But again, it's too optimistic because it just happened, right? You have no data. Cool. So here is my alternative story. Okay, my alternative story here is, and I don't know if it's true or not, it might be, but it's plausible to me. The market got a restructure. You have, you're under pressure to lower your fees, there's less profits, and what are you going to do? Either increase your price, higher fees, somehow lower your costs, or just abandon. And in my mind, an M&A transaction can achieve all of them, right? Somehow, I mean, I can lower my costs by spreading like using the same people to do more deals. I can abandon some of the markets once I merge, and maybe I can increase the price. So in this sense, in this kind of alternative story, the counterfactual is that without the M&A, I'm under this pressure, and I'm already operating in small markets that are higher cost markets. There's the reason why the fees are higher in these guys and the nationals are not coming. So in this story, if I kind of block M&A, I think there'll be more exit, more underserved markets. So as a regulator, I'll be like, maybe 5 basis points is okay, like higher. maybe 5 basis points, fine. So there's this trade-offs. So that's where kind of, at least I'm not questioning the results. Everything's well done. The interpretation can be flipped around because of the way the market's kind of, again, in academia, we just jump and yell about indigeneity and stuff. But I think the small regional players here, in particular, are under a lot of pressure and have high costs. And another thing that kind of treatment here is defined as a market that do not have many players by definition, because this is a market where once two guys merge, the Herfindahl index jumps up, which means that there are not many players to begin with. So the treatment itself is defined in a way that kind of focuses, zooms in exactly in this kind of underserved markets. All right. And there's also, I think that there must be some reverse causality going on here, because essentially we regress due characteristics like fees, yields, issuance amounts on the consolidation. These guys must be idiots when they consolidate, not thinking about what kind of fees we can charge, what are going to be the yields we can deliver, and how many amounts we can place. I don't think it's the biggest problem in here, but still there's some. So that's why I'm going to push the authors a little bit in thinking about this and kind of, okay, think about this, about the M&A process itself, what's happening, and kind of modeling it a little bit. Because to me, when you have these nice pictures, which don't look so nice anymore once I kind of handle them, you have this merger here and that merger there. But to me, it looks like many of the mergers here between like RBC and William Hill are not driven by some desire to kind of concentrate and squeeze the market. They're more like, let's kind of cover even more of the US and then lower the costs. Because I would have said maybe then SunTrust should kind of pair with William Hill and corner Florida. I know, this is like I'm discussing here, this is completely make-believe, right? Because the times are different. But still, it seems like many of these kind of deals are not done to squeeze the market. All right, so I have 19 flats. I'm going to show you my house, but unrelated here. A small gripe, I think you should kind of cluster at the time, because not clustering at the time, you overcount, so that's why I get so precise results with small standard errors. But here's like my suggestions. I think just looking at this from other angles, in particular the Citigroup and UBS kind of withdrawals can be arguably more exogenous to some of the markets, would be great. I know it's unfair comment because you don't have data, but in a year or two, you'll be like an assistant professor in Michigan State or Penn State, and you get the data. Looking at another angle is going to be great. I also think you gotta somehow model M&A. I think there's an opportunity. There's a lot of painstaking work Rimping has done to collect all this data. So just kind of modeling the M&A and maybe even kind of reduced form, looking at what predicts an M&A. Are there like this kind of pressures I'm talking about, or is it more exogenous? Right now, the paper structured as this is the experiment. I'm going to defend it and die on that hill. I think there are more hills you can die on. In particular, I'm not pushing for a structural model, but these are more and more cool and more used. I think understanding the M&A can help a lot here to kind of, because this market is changing, and the M&A is a very interesting component of the change. So in conclusion, very interesting work, very thorough, very well done. I think we need a little bit more to nail down the policy implications here, which are important. Thank you.
All right, thank you both. It seems like it's probably good to open things up so we can get feedback from practitioners as well. So go ahead, please say your name before you ask your question. Okay, in the
back. Dave Erdman again from Baker Tilly Municipal Advisors, but talking more as a past issuer. All the papers this morning have been kind of the same theme. Competition, lack of competition, and as an issuer, the competition was always good. I mean, the reduction of firms not only impacts the data you're looking at, but just general ideas to an issuer. I mean, some firms focus on transportation, some focus on securitization, some focus on golf courses. So it's just, you start losing firms, you lose some of the ideas. A couple of the discussants, though, have mentioned about the race to the bottom. And I think one thing that I've seen after I moved from the government side to the municipal advisor side is that large issuers, the Wisconsins, the Illinois, the Massachusetts understand, underwriting spread and how that relates to underwriting bonds and, the health of underwriters and so forth. But you have a lot of mid and smaller size issuers that still have a lot of procurement rules they need to follow. And they will, press your advisor and move forward and go through an RFP process and ask, well, if we're doing an RFP and we get, response that says, I can run this bond for $2 a bond versus $10, why would we go with $10? I mean, $2 is, the cost of widgets and pencils. So, looking at, local, smaller, mid-sized procurement rules could be something to look at as to do past procurement practices kind of drive or enforce this race to the bottom, unfortunately, in the big sector of our market.
I see. Thank you for the suggestion. I will look more into it. Thank you.
Hi, Dan Smith, Boston College PhD student. I had a question around, I remember when I was reading your paper, I believed your story, but what I found kind of confusing, and I'm sorry I don't really remember the numbers exactly, but you had a section where you looked at government finances, and so the effects on muni bonds weren't massive and kind of what in line with what I expected, but then when it got to like the government financiers' response and like how the government adjusted its finance accordingly to these M&As, it seemed outsized to me. Did you also get that sense? And if so, do you have an explanation for that? Or?
Are we talking about the size in terms of the increase in interest cost or the drop in new issuance? Which one?
Both of them. Like, I guess across the board, like just how the government finance responds. I don't remember like all the exact metrics, but I know you had like a whole section where you had like a table where you looked at all these different avenues of like how the finance has changed.
My finding is after M&As, the ratio of interest cost relative to the total expenditure increased by 0.07 percentage point, and the amount of new issuance as a ratio to the total expenditure drops by 0.5 percentage points. So this is the magnitude I found, and I think this is kind of in line with my expectation. But I wonder, can you be more specific about the magnitude? And are you talking about this elasticity of quantity to the price? Can you be more specific about the quantity? Oh yes, so this is also something that I really wrapped my head around. So one of our findings is we see a large drop in the amount of intergovernmental transfer from the state government after the consolidation of underwriters. And my interpretation of it is that these consolidating activities, they are also affecting the financing cost of the state government and the state-dependent agencies, and because of that, the state government needs to keep more funding to itself, and that kind of crowd out is transferred to local governments, and we think this might be an indirect effect of the consolidation that we are capturing, and this might explain why the increase in tax is kind of high relative to the maybe the drop in issuance or the rise in the interest cost.
Great. Other questions?
Hi. Sort of actually follow up and related to it.
Introduce yourself.
Sergey Chernenko from Purdue University. The timing also of property tax increases seems a little bit puzzling because it happens in year zero and is stable afterwards. I don't know if you have any comments on that. It seems surprising that in the year of the M&A, immediately municipalities will raise their property taxes by more than 1 percentage point.
Yes, so this is a very good point, and honestly, I do not have a very good answer for that. So I have tried using other transformations of variables doing it locked or per student, per resident, and the effects are kind of very robust, and I need to think more about how to explain this. Thank you.
Hi, Yaffa Ratner, Hilltop Securities. I'm particularly curious to hear more about two things. One, you mentioned post the M&A activity, you've seen an increase in interest costs. And I'm particularly curious how you quantify that, and are you holding constant just changes in the interest rate environment with respect to where interest costs are right now? So, for example, when you had seen the slides that I had shared with you, the data between 21 and 2022, we had gone from, a close to a 0% interest rate environment to a 5% interest rate environment. How have you held that information constant when you ascertain that there's been an interest increase post M&A activity? That's my first question.
Okay, so for the interest cost that we see at the final table, it is from the survey of local government's finances. So it is what the local government reports that they are paying as the interest, and as to the general time trend. So one thing that I have done is I have included time fixed effect. So I'm effectively demeaning this variable, and I'm already partially out the effect of general time trend in terms of the interest cost over time, and also have a trade control matched sample, and the control is with the same time frame, so they are comparable in terms of their overall interest rate that they are facing.
I'm not following you, because if you move from a 4% interest rate environment to a 5% interest rate environment, then all governments, regardless of rating, are going to be paying more in interest costs year over year. So I think coordinating or synthesizing that relationship just happens to be more almost environmental than a reflection of an M&A activity. And I would respectfully suggest that perhaps you might want to focus your information a little bit more either succinctly or acknowledge the fact that you've got other inflationary pressures that are driving interest rate increases, as well as the need for higher property taxes beyond M&A activity.
I see. Thank you.
Thank you for that paper, and they've all been excellent. I did have a suggestion or maybe a question as to whether or not you include the regulatory cost that firms face before consolidation and after consolidation. In the analysis of the paper, I'm sorry, I missed your name. The gentleman mentioned that you can either increase price, lower cost, or abandon the field. And we often hear that regulatory costs drive some of the incentives, or could potentially drive some of the incentives for those consolidation. Have you considered that as part of your paper?
Yes. So one thing I have done is I have read through the news reports for these M&As and look at the rationales according to them, and I found about 10 cases of these M&As. They are driven by regulatory pressure. So they are saying that okay, the regulatory cost is high, but if we make our pie higher, then it will be smaller relative to the size of our businesses, and that can spread it out. So that is quite important driver of the M&As in my sample.
And one other question I wanted to follow up on. I believe this was in my notes under your section, underwriters structure bonds for their own benefit. You mentioned that. And was that in relationship to the call features that you...
And sorry, and can you repeat the last?
Could you clarify what you meant by underwriters structure bonds to their own for their own benefit?
So I found some evidence of, for example, less use of callable features after the M&As, and I think that's one example of, I think maybe it could be that maybe the underwriters are influencing the issuers to use less callable features, and when there's less callable features, then the bond can be more attractive to the investors and make the task of underwriter to market them to be easier. So I think that can be one place where the underwriters influence the offering terms. That's possible, according to my findings.
So I want to thank Christine and the panel and Peter for a very lively discussion, which I enjoyed, but also for the very good papers. We're going to take a 10-minute break. We're a little behind, so let's get back here at 11:15. 11:15. Thanks. Begin. We're very fortunate to have Melissa Moy from the Treasury, who's going to moderate the next session. On behalf, she's not speaking for Janet Yellen or anybody else in the administration. So, Melissa.
Thanks, David, and thanks to everybody who came today. There's been a great conversation so far. And thanks for turning on the mic, Howard. So our first paper, I'm going to make it very quick here, is Federal Assistance in Municipal Borrowing, Unpacking the Effects of the CARES Act on Government Liquidity Management. And we have here Luis Navarro. He's a PhD candidate at SPIA, which is the School of Public and Environmental Affairs at Indiana University. His research focuses on public finance, especially the municipal market, and state and local tax and debt policies. Luis?
Thank you. Thank you for this wonderful introduction. So I will skip me introducing myself. And this is one of my dissertation chapters. So let me just begin. So in this paper, I broadly examine the effect of federal aid on local government borrowing during macroeconomic crisis. And at first sight, this relationship is not clear. Why, when in one hand, while federal aid could alleviate the liquidity pressures experienced by distressed governments, it would also signal the market that these governments are more prone to experience larger economic dislocations. So this is an empirical question that I aim to study using the quasi-experimental setting created by the Coronavirus Relief Fund, in which some local governments received direct assistance from the Treasury and some others did not. In particular, in this paper, I look at county government outcomes both in the primary and the secondary market between April 2020 and December 2021. And I will be looking at measures of their borrowing cost, in particular bond spreads, and measures of the per capita debt issuance and traded in the secondary market. So to preview my findings, bonds issued by these CRF recipients observed a reduction in their primary market bond spreads between 7 and 9 basis points. These are relatively mild estimates, as they are within 0.12 and 0.17 standard deviations from the average spread observed in the sample. They also observed an increase in their primary market debt issuance between $1.7 and $5 per capita. These are also relatively small estimates, as they are within 0.13 and 0.39 standard deviations from the average amount issued. The results for the secondary market, though, are mixed and inconclusive, so I cannot draw a lot of conclusions from that, besides that the effects appear to primarily appear through the primary market. And in terms of the mechanisms that could be shaping these results in the primary market, I find that in the margin, lower-rated governments observe larger spread reductions, and across the board, that means for governments both in the treatment and in the control arms of my study, there appears to be a substitution from longer-term debt towards shorter-term instruments, which highlight part of the magnitude of the liquidity pressures and the liquidity management undertaken by governments during the pandemic period. So let me briefly describe the policy I am analyzing. So the Coronavirus Relief Fund was the arm of the CARES Act that channeled money through state and local governments at the onset of the pandemic. It comprised an allocation of $150 billion that was allocated across state governments proportional to their population, with no state receiving less than $1.25 billion. And a key characteristic of this policy that I exploit is that the guidelines establish that counties and cities with a population above 500,000 people receive direct aid from the Treasury that was subtracted from their home state's allocation. There were 154 local governments that received direct assistance, out of which 118 were county governments spanning 32 states. And another key characteristic of this policy is that despite the Treasury imposed some restrictions in how the money could be spent, there was some fungibility of these resources, as these could cover any necessary expenses incurred due to the health emergency that were not accounted in their local budgets before the day of the implementation of this policy, which was March 27, 2020, and that were incurred between March 2020 and December 2022. So I analyzed this using data from IPRIO and the MSRB, I include all bonds issued and traded by these county issuers. That includes county central governments and agencies of the county, departments, authorities, trusts. As I said, I use as my dependent variables bond spreads both at issue and at trade in the secondary market, and the amount issued and traded per capita. And I study the quasi-experimental setting created by the CRF using the intuition behind a regression discontinuity design, in which for governments whose population is within a narrow bandwidth around this cutoff, CRF eligibility mimics random assignment. So I will be looking at only bonds issued by these governments that are like within a neighborhood or a close neighborhood around this 500,000 population threshold. So the first step of my analysis is fixing this threshold and to determine the set of bonds that will be included. So for that, I adhere to the methodology developed by Calonico and co-authors and estimate the optimal bandwidth for each of my dependent variables in the post-intervention period, and then just take the average, which leads to a threshold of 142,000 people. And that leads to treatment, a partition of my set into a treatment group that, for example, for the primary market includes roughly 1,400 bonds issued by 44 issuers that cover 27 counties. For my control group, there are roughly 1,600 bonds issued by 60 issuers from 50 counties. For the secondary market, relatively similar distribution, but of course, way more bond trades. And just let me begin with describing some of the statistics of my sample. So these are some graphs that you might remember, but like at the onset of the pandemic. So first, like the panel on the left is the spread stat issue in the primary market. The panel on the right, the amount issued per capita in the primary market. And as you might remember, at the onset of the pandemic, spreads spiked, and it took some time for them to return to pre-pandemic levels. And the red line is the spreads for the treatment group. The blue lines are the spreads for the control group. And at least at first sight, there appears not to be any visual differences in the spreads. In terms of the amount issued, it seems that there was a larger per capita issuance from issuers in the control group. For the sake of time, I do not show you the graphs for the secondary market, but they do show similar trends with the caveat that there are narrower differences between these two groups. Now, let me show you some changes in the distribution of bonds issued in the primary market between the treatment and the control groups before and after the intervention. So these graphs are showing the distribution of bonds by credit rating. And something that stands out is that the panel on the left is the treatment group, the panel on the right is the control group, the bar on the left is pre, the bar on the right is post. So for the treatment group, while the proportion of bonds of AAA remained relatively stable, it appears there was some deterioration on the overall credit worthiness of CRF recipients, since there was an increase in the proportion of A-rated bonds that came at the expense of a reduction in the proportion of the AA-rated bonds. And interestingly, the story for the control group seems to be slightly different, as there was a decrease in the proportion of AA-rated bonds that came at the expense of an increase in the AAA-rated bonds. So some possible interpretations of rationales behind this. For the treatment group, it could be the case that there was heightened credit risk for lower-rated, highly populated areas, whereas for the control group, it could be that these higher-rated governments observed improved access to the market, so that the increase in the AAA-rated bonds could mean that just these AAA-rated issuers were more active in the market. So now, in terms of the maturity structure of these bonds, this is the same analysis, but instead of looking by credit rating, I partition the bonds by their time to maturity. And for both terms in the study, there was an increase in the shorter-term bonds, where the inflection point is found at the 10 years maturity. So bonds with maturity lower than 10 years increased, the proportion of bonds issued increased for both the treatment and the control group, and at the same time, it came at the expense of a reduction in the bonds whose maturity is above 10 years. So, and more importantly, the effect seems to be slightly larger for the control group, and when I test whether this change in the distribution is statistically different before and after the intervention, while it doesn't seem to be significant for the CRF recipients, it is for the control group, which highlights the magnitude of the liquidity pressures that these governments observed, and it also shows that given the uncertainty around the effects of the pandemic in the first stages, it implies like there was some deferral of the longer-term investments done by these governments. So, for the empirical analysis, as I preview, I used a regression discontinuity design. I include in this bot sample, as my control variables, I include the traditional set of bond characteristics that appear in your bond pricing model. And to control for the magnitude of the effects of the pandemic on the county, I include the county monthly unemployment rate, as well as state fixed effects and month-by-year fixed effects. I estimate this model using both a parametric and a non-parametric estimator with linear and quadratic specifications on the polynomial term. And as you may know, for the identification of NRD, I need to conduct manipulation at the cutoff test. So just to preview that, like the results for the Macquarie test for both the primary and the secondary market show no evidence of systematic manipulation of the running variable. So that box is checked. Just to recap some of my results, the regression discontinuity design shows that relative to the bonds issued by the control group, CRF recipients observe a reduction in their primary market spreads between 7 and 9 basis points with an upper bound estimate of 47 basis points. However, while this is larger, it's still within 0.9 standard deviations from the average spread in the sample, so still relatively low estimate. For the primary debt issuance, there is an increase between $1.7 and $5 per capita. For the secondary market, the results are mixed and inconclusive, yet they do provide some suggestive evidence that aligns with the story for the primary market. There was a reduction in the spreads at trade for these bonds issued by CRF recipients, as well as an increase in the trading volume of these bonds. So, in terms of the robustness checks that I conduct for the paper, as you can imagine, perhaps the main assumption I'm making is this cutoff or like the bandwidth that I am using to analyze these bonds. So as I said, I computed a bunch of bandwidths and take the mean for the main specification. For the robustness checks, I looked at the borders of the interquartile range, so the 25 percentile and the 75 percentile. When I am impose a stricter assumption on the bonds that could enter this analysis and looking at the 90,000 bandwidth, I find stronger results. There is a larger reduction in bond spreads between 12 and 23 basis points, still relatively low as they are within 0.5 standard deviations of the mean, and a larger increase in debt issuance, that is between $2 and $8.7 per capita. When I look at the results using the larger bandwidth and include more bonds into the analysis, the results are still within the magnitude and precision found in the baseline model. So this exercise seems to be robust to that assumption. And another robustness check I conduct is that in my baseline sample, I include bonds issued by agencies of the county, their trust, their authorities. When only including county central governments that arguably were like in some cases, the ones that received the direct assistance, I find also stronger results in the primary market, a reduction between 23 and 25 basis points. And I also get precise estimates for the spreads at trade in the secondary market with reductions between 23 and 58 basis points. However, in this robustness check, there is mixed evidence in terms of the amount issued and traded, the amount issued in the primary market and traded in the secondary market. And to examine to which extent these results could be heterogeneous across the credit rating that these bonds get assigned and the maturity of these instruments, I expand the regression discontinuity design to add interactions with the categorical variables of the credit rating and the maturity structure and estimate these models independently. Just to go quickly through these results, this confirms some of the descriptive evidence found in the bar bars I showed you before, as they suggest a substitution of longer-term instruments towards shorter-term ones, still within this 10-year inflection point. And there was a large and significant reduction in primary bond spreads for A-rated bonds and above, where in the margin, the A-rated bonds observed larger spread reductions. So just to conclude, in this paper, the findings indicate that recipient governments observe mild reductions in their borrowing cost and increase their issuance in the primary market, where there appears to be no significant spillovers to the secondary market. And furthermore, the results of this analysis indicate that federal aid produced crowd-in effects for local governments that enable the provision of local services in a time of distress. So just for the sake of time, I will conclude. Thanks for your attention. I recap. I'm Luis Navarro. I'm a PhD candidate. I'm in the job market this upcoming cycle. So if you're hiring, I'm your guy.
Thank you, Luis. Lauren Larson is well positioned to comment. She has got years of experience at OMB administering TARP. And she's also been at the Colorado Planning and Budget Office under 2 different governors and served as the president of NASBO. So thanks, Lauren.
Hi, thanks for the introduction, Melissa and Luis, for looking at this really critical time in our country's history. So, as Melissa mentioned, I was the budget director in Colorado at the time, and President-elect of NASBO, we were getting together weekly on calls to figure out what was happening across the country. And so if we could all sort of together in the room and go back to that time when there wasn't a plethora of stimulus around. It might be hard. You might need to close your eyes to go back and remember this time, but it was really terrifying. You know, we were watching the runs daily, weekly, you know, the revenues just precipitously drop off. And in the time between March 27th and the end of April, which that's the time between when the CARES Act was signed and when the money showed up in our bank account in Colorado, I had run a sequestration and cut current year funds from agencies. I had updated my budget committee that they would need to cut 25% from the governor's budget request that very year or within the next month or so. And I had issued guidance to agencies that on top of that 25% cut, they were going to have to do another 10% for the year, the planning year, the fiscal 22 that was coming up. We were forecasting to burn through our cash reserves in 90 days. Just we'd be depleted. So it was a crazy time. The CARES Act money was so welcome. It was I had a $3.4 billion budget hole, and what was coming to Colorado was $1.7 billion. So it's like, whew, that's going to be a big help in filling the budget hole. But it was, you know, really unclear about how fungible the money would be. The statute was pretty strict. And it's illustrative of how much variation there is in how states and locals interpret federal statute, because some people in NASBO were terrified, saying, no way, we can only use this money for public health emergency expenses, this few, you know, a couple $100 million of expenses I had over here, and no way can it help us with this multi-billion-dollar budget hole over here. And there were some really firmly in that camp, and then there were others that were more leaning in on the risk and of being able to use it to fill the budget hole. And it all was just contingent on what was Treasury going to say and what would the guidance. So much of it was dependent on the guidance. So that's sort of the context of Luis's paper. And so it's very clever what he's done. He's taken the narrow band around local jurisdictions between just below and just above 500,000 population, the ones that got one and didn't, which is it's a natural experiment. It's probably as close to an RCT as you could get in emergency conditions. So I thought it was a very clever approach. And I have 3 considerations for why things to look into and why he might have the more mild findings that he has found. So first, I think his results are probably muted. And there was a lot of pressure from these jurisdictions on the states, the jurisdictions that didn't get a direct distribution. So you can imagine, they were all watching their revenues drop off. It was terrifying for everyone. And then you find out you're cut out of this money that's coming. It was tough for them. And they made a lot of noise. So in Colorado, we shared our CARES Act distribution. We shared about 15% with the locals that didn't get it. And there were many other states that did the same. So I think a next iteration, the paper could do that research. It's a little messy, but it's probably doable given the small sample size, and pull out and control for that and probably get a more robust effect. Secondly, this wasn't just a fiscal crisis. There was a pandemic on, and something in the paper to acknowledge, explore what controlling for some of the impacts of the pandemic were would be helpful. So disease incidence or hospital capacity, or you could even just look at density, because that really shaped how the pandemic spread through the country. So that would be a second consideration to look at. And then last, he has a finding on duration, which didn't surprise me at all. The shift to shorter term maturities from longer term, and Luis makes the conclusion in the paper that there was probably a reduction in long-term investments. I think that's probably true, but really the primary reason I would suspect for that shift is that there was so much talk about how much more stimulus was coming. And if you remember the fall of 2020, there was the Consolidated Appropriations Act of 2021 that was being hotly debated in Congress, and that would bring some relief. And then in early 2021, of course, all the iterations around the Rescue Plan Act and was coming or not. So I think a lot of the shift had to do with hoping and a lot of hard lobbying for additional stimulus to come. So just, again, thank you, Luis, for researching this important time in our history. Thank you, Brookings, for bringing together practitioners and researchers to learn from each other.
If you'd like to go ahead and respond to the comments that Lauren made, please.
Yeah, of course. Well, first, thank you, Lauren, for this wonderful feedback. Yes, I will try to give some brief responses to that. Well, first, I'll try to be in order. In terms of the fungibility of the money, you are right. There is and I included this later on the paper, so hopefully I will expand it more. But there is a GFO report that surveys the CRF recipients and asks them where were their concerns at the beginning of the pandemic regarding this. And yeah, most of them report that it seemed to be for them that the fungibility of the money was very strict, and they weren't sure which expenses they could cover. At the same time, the Treasury continuously updated these guidelines, arguably dissipating some of these uncertainties. So between March, the enactment of the policy, and I think September 2020, there were 4 updates in the guidelines of the CRF. And also, surprisingly, when you check the velocity that were in how the money was spent, I think it was by September 2020 that roughly 90% of the CRF allocation was already spent. So while, yeah, it was strict how they could, in which categories they could spend, they arguably spent it, in a relatively fast pace. It could imply that there was a suboptimal allocation, that maybe some states or local governments did not allocate those funds in the areas they could have wanted, yet they could spend that money. Okay, second, in terms of another wonderful comment about the indirect payments that some governments received, yes, when I start playing with that data, but just to share some, ballpark results of that, I think in my sample, it's roughly that just like you said, 50 and 50% of the governments in the treatment and the control group receive some sort of indirect assistance from their states. Yet when I check whether this assistance is correlated with like the population criterion, that means whether the state governments give the money to the larger counties or to the smaller ones, it doesn't seem to be a correlation. So like I would expect that when I do the analysis, the results do not change that much, as like population is not a predictor of the magnitude or the probability of receiving those indirect payments. And you're right, like about the third, about the using health outcomes as a sort of control variable. In past iterations of the paper, instead of using the county unemployment rate, I was using COVID cases per capita. And as you can imagine, these two were highly correlated. Like the places that experienced larger dislocations were also the ones with larger COVID prevalence. So I could include as a robustness check maybe shifting these two variables and see to which extent they could shape the results. And
duration.
Oh yes, the duration. That's a really good point. So yeah, like oh yes, the shift towards longer-term instruments towards short-term ones, like the descriptive evidence picks that up, and something that I would like to explore more in the paper. It's like, and I do only provide some descriptive evidence on like to which extent the changes in bond prices reflected these changes in the distribution of bonds issued. But yes.
Very good. So I'd like to open it up for Q&A for Luis and Lauren. Has he answered all your questions? Any questions about the municipal liquidity facility?
I mean, I can talk a little bit about that.
Just a minute.
Yeah.
Oh. There's Luis. Yes, go ahead.
Thanks, Louise Chenna from the Hutchins Center. Two things. Even if there's no correlation between how much money they got from indirectly and population, so your results are fine. When you think about the interpretation of the results, though, then you might want to say, well, how much liquidity different, like, so everybody got liquidity, not just these. And in fact, they didn't get what they took, some of the people who got money spread it. And so I think I'm wondering how you think about the interpretation of your results and how it would apply to a future crisis or you know, number one. And number two, just in terms of the spending, there's something we talked about at the lunch yesterday. Of course, everybody wrote to Treasury and said they, quote unquote, spent the money, but the evidence that they actually changed their spending above what they otherwise would have spent is pretty bad. So we don't really know when the money was spent or if the money was spent, in the sense of them doing something different than they otherwise would have done. And I don't know how that impacts how you think about it.
Thank you for those wonderful questions. Regarding the first one, you're right. Like when I say that the results, I expect them not to change, I'm mainly talking about the direction. Yet you're right, the magnitude might change as like some of these governments might have received more assistance than the others. So as I said, like in my sample, it seems to be that it's like 50-50. So like in a further, sadly that exercise didn't make the cut for this presentation. But I would expect that perhaps the only challenge that I will face with that is that as I reduce the sample size, I might lose some precision. Yet maybe I find smaller estimates for the governments that received, direct and indirect assistance. And in terms of your second question was about the day they reported the spending. Yes, you're right. Like the data I use about the velocity at which they spend the money is self-reported data to the Treasury. So it could be the case that that not necessarily aligns what this gets to their financial reports. A further step of that would be, and I'm considering that, trying to bring in data from their actual financial statements and see whether these reflected changes, for example, in their general fund balances, and actually look at whether they came out of the pandemic, like maybe more or less cash with cash reserves. Yes.
Hi, can you take a moment and perhaps expound a little bit around the thesis of short-term versus long-term transactions that you were referring to during the height of the pandemic?
Yeah, of course. So for the analysis, I partitioned the set of bonds between the time to maturity. So I used, buckets. It's like 0 to 2 years, 3 to 5, 5 to 10, 11 to 15, and 15 to 20, and plus 20. And with that partition, what the descriptive evidence and the part of the econometric results show is that for this 10-year threshold, like for bonds below the 10 years of maturity, there was an increase in the proportion of these bonds in the overall distribution of bonds issued. That naturally came at the expense of a reduction in the proportion of bonds issued of longer maturities. Right now, I had been thinking a lot of why it was like this 10-year threshold, because, for example, in my initial guess was that I would expect a drastic increase between the 0 to 2 year bonds, because this was more like a liquidity management type of, crisis. However, and as you may know, the proportion of notes in the market has been decreasing over time. So I wasn't sure that was necessarily the right way to capture the magnitude of the liquidity constraints. And that's why part of the interpretation of the long-term investments deferral, which is maybe looking at more at the longer-term planning of the governments in terms of how they will allocate the debt in the market.
Okay. That was super helpful. Just one last comment. You might want to think about segregating that data almost during monthly increments, if possible, during the start of the pandemic. Because if you recall, during the start of the pandemic, particularly that first month or two, huge stock market volatility.
Yes.
Rates were driving up, right, until they ultimately corrected. And I'm curious, and I don't know the answer to, if any of those facts really changed the duration of the transactions during different months during 2021. And I would encourage you to take a look at that data monthly if possible.
Yeah, no,
See
thank
if there
you.
are any patterns that you could discern.
We have one more question, if we can take it quickly. Brad?
Hi, I just want to make sure I understand the hypothesis.
Could you, Brad went, right?
I'm sorry, Brad went with Charles River Associates. Thanks, Melissa. Has after the pandemic, the length of the maturities increased? Is that what we're saying, or what?
No, there was the proportion of bonds of shorter maturities increased relative to the proportion of bonds of longer maturities.
So you had more short-term bonds.
Yes.
After the.
Yes, after the intervention. Like that, and to be precise, I am comparing January 2019 to March 2020 versus April 2020 to December 2021. And the idea of me choosing these 15-month windows is to allow for the governments to have the chance to go into the market and issue debt. The idea was that, and maybe not necessarily all the governments will be going to the market, in April, May, or June, as there was heightened uncertainty on the spreads, and it took some time for them to normalize. And also, it could depend on the nature of their budget cycles. So that's why this comparison, it's capturing medium-term effects of the policy.
Thank you. I'll review your paper.
Yeah,
it's
thank
very
you.
interesting development. Thank you.
Thanks so much, Luis, and also Lauren. And we will bring the next paper up, which is Andrew Kalatai, who is, thank you very much.
Yeah, thank you. And thank you for this wonderful conference.
Andy's a leading municipal analyst. He's published widely and has taught at various higher education institutions on bond valuation and other analytical methodologies. His experience includes building his own bond analytics firm, a number of years at Salomon Brothers and Dillon Reed and AT&T, and he holds a PhD in mathematics from University of Toronto. The discussant will be Alan Garman from the Maryland Transportation Authority, and he's the Deputy Director of Finance. He previously served as a municipal credit analyst and portfolio manager at Legg Mason, holds an MS in finance from the University of Maryland. Thank you very much.
Okay, Melissa, thanks so much, and thanks to Brookings for inviting me to speak about my favorite topic, which is bond refunding. And I'd like to start with a question for the audience. As you know, there's an ongoing activity in refunding of tax-exempt bonds. If you look at the taxable market, taxable corporate market, which is about 10 times larger than the munis, it's about $40 trillion. You never hear about refundings. What's the difference? I hope you know the answer. Why is it that munis are always refunded and corporates are not refunded? And if nothing else, I hope you'll understand by the time I finish what's going on here. So I hope many of you know the answer, and if not, let me tell you. It's because most munis, most institutional munis, they come with a 5% coupon, callable in 10 years at par. And those are designed to be refunded. What was happening prior to 2017, when munis could be refunded in advance of the call, most of these 5% bonds were actually refunded. I was involved in cases where the ink hasn't dried on the official statement, and the banks were already talking about refunding because you could easily beat the GFOA guidelines. So what happened in 2017, advance refunding was eliminated, and there was a halt in refunding, short one, because then the banks started suggesting, oh, look at the taxable rates. You could refund and save with the taxable rates. That didn't seem like a good idea, but many issuers did it. I gave a talk about this last year. Marty Luby and I wrote a paper about how much money was actually wasted. With perfect hindsight, we can look back at these rates and we can see, had these municipalities waited until the call date, how much more they would have saved. And we're talking about literally billions of dollars. No argument. The paper is coming out, by the way, in the Public Finance Journal. It's a new journal, very nice journal. I advise you to take a look at it. So the topic today is a new type of refunding, which is tendering. You buy back your not yet callable 5% bonds, mostly 5% bonds, and then refund them with new bonds, which are also typically 5% bonds. I'll talk about how to decide whether to refund or wait. And this is very general. I'll apply it to this particular case of the tenders, but this is what should be done, and what I'm going to describe is more than 40 years old. So what's happening in the municipal market, this is my understanding. How do you decide, should I refund, should I not refund? The underwriter, the advisor, the issuer, they sit down and they start having some profound discussion about where interest rates are going to go. Of course, nobody has a clue. And then based upon whatever insights they have, they make some decision without any reference to option valuation. It's an insight. Yeah, I have a gut feeling that rates will do such and such. And it's complicated because both the outstanding bond has a call option, but then the refunding bond is also callable. So you have all these options all over the place, but nobody is valuing the option. And what should you do? It's actually not a very difficult issue. It's straightforward. First of all, you calculate savings. Everybody knows how to calculate savings. And then the only other thing you have to do is say, what do I give up? I give up the option to refund the bond later. Well, there's a little bit more to it because if the refunding bond itself is callable, you have to look at the option value of that you acquire, but it's not difficult. It's not difficult. There's standard technology for doing it. And so what you should do is calculate what is called refunding efficiency, which is simply a comparison of what you save versus what you give up. And you should not throw away the call option without getting enough for it. This ratio should be at least 90%, preferably higher than 90%. So that's it. Just do refunding efficiency, not difficult. Technology is readily available. It is, to the best of my knowledge, it's not being used for whatever reason in the muni market, it's used everywhere else. And I'm going to give you an example of how to do it, but you can do it easily if you have a Bloomberg terminal or whatever analytics. I'll give you an example. This is the Massachusetts Water Resources Authority. Typical for every one of these other tenders that I have looked at, a 5% bond callable in 43, and the tender price happens to be 109.86. And then let's assume it's refunded, it was refunded with a like bond with a longer call protection at the same, maturing at the same time. So how do you value this thing? There's one difficulty in the municipal bond market in terms of muni analytics that you don't have elsewhere, which is that muni rates are not known, interest rates are not known beyond 10 years. What we have is the yields of callable bonds. Those are not interest rates. And to do proper valuation, you must have interest rates, not yields. And if I ask this audience, what's the 20-year AAA muni rate? Nobody will know. It's unbelievable. Yet that is absolutely essential for proper valuation. So what can you do? If you don't have interest rates, you cannot value bonds, period. So you have to figure out the interest rates, and it's not that difficult. What you do is you can extract that from the callable rates by stripping out the call option. I won't get into it, but I'll just give you an example. For this, so you can see in the second column the actual rates for this issuer, the 2-year rate 2.5. That's not callable anyway, but the 15-year rate is 3.20. The 20-year rate is 3.51. Those are the callable rates based on the official statement, and then you apply the right volatility and calculate the implied optionless rates in the third column. Are they reasonable? The way to find out whether or not they are reasonable is to compare them to treasuries, because those ratios have to be in certain areas. Again, I won't belabor that point, but this is not very difficult. Use 30% volatility. It doesn't mean much to people, but you can read the paper if you like. And now we have the optionless rates. And once you have the optionless rates, you know, the sky is the limit. You can value everything. You can value savings, you can do options, and I will give you what happens in this case. First, you calculate the savings. You look at the old bond versus new bond. Everybody knows how to value savings. That this industry is wonderful in, but savings calculation. So you figure the savings amount to 2.91%. Then on step 3 at the bottom, you calculate the option value, which is the old option value minus the new option value, which is 5.11%. And in step 4, you get this refunding efficiency, 57%, which means you got barely half of the value that you have given up. Very straightforward. But there are a couple of things that I would like to point out, which is, I refer to them as the related results that you don't see. But once you have the analytics, they just fall out. So for example, you remember the tender price is indicated on the top is 109.86, but we also can calculate the fair value, which is never shown anywhere in these documents. And the fair value of the bond is 106.36. So how much did we pay for the bond when we in this tender offer? 3.5 points. That's a lot. That's what you're paying to get the bond back. And something else which also falls out, had I refunded with an optionless bond instead of a callable bond, I would have saved 13, almost 14 points, which is fantastic. It surpasses every guideline you've ever heard. But it's not enough. You should be saving, in this case, 17 or 18 points. I mean, that's the issue here. What is reasonable? And it's only through option valuation that you can get sensible answers. You can't look at the GFOE guidelines because they're meaningless. So the point is that most of these tenders were, the premiums were about 3 to 4 points, sometimes a little bit less on shorter bonds. And the efficiencies, like this is typical, were very low. Just to tell you a little bit about the transactions today, there have been dozens and dozens of these. They are being promoted even today. It's hard to get the documents because you need the tender document, you need the acceptance document from the issuer, and then you need the new issue document about how they refunded. So it's hard to mesh all these, and yet don't have the same consistent information. But you can do it, and you can do the calculations. The investor response has been very poor, usually much less than 30% acceptance. I'll mention why not. One of the problems is that the holders are taxable. So if you offer a premium, they have to pay tax on the gain. Some institutions, we were talking about them earlier, they cannot sell. They hold to maturity, so they cannot participate no matter what. And then retail, they don't even trust these. They don't understand what's going on, so they will not participate. So they have been very poor in comparison to the taxable transactions that I will mention in a minute. The value of these transactions, in a simple English, is the premium that you're offering. 3-4 points. About corporate tenders, I do want to say a few points, make a few points. I worked on these back in many years ago. First of all, you can refund corporate bonds only if the interest rates fall below where they were at issuance. Not 5%. The munis are refunded no matter, as long as rates are below 5%, they are refunded. So that's why you have this ongoing churning and churning and churning. So, but there were opportunities, and just to give you a bit of color on this, in also corporations could deduct the premium they paid as ordinary income tax to 46% then. And you hear today about corporate taxes being 21% or 15% or whatever. 40% tax rate makes a huge difference when you're doing the analysis. So there was any tax incentive for doing it. In 1977, when the Bell companies refunded bonds that were issued in 1974 when treasuries were at 8%. In 84, there were refundings of bonds which were issued in 1981 when long treasury was 15%, just to give you some idea. But the point I want to make is that in all these transactions, back in the 70s, refunding efficiency was used to make a decision, completely lacking today in the municipal market, 40 years later. Perhaps somebody can explain why. So, a couple of more points. What should issuers do? They should be issuing optionless bonds. It's so simple. Or bonds with very high call prices, but not these bonds which are designed to be churned, to be refunded. Let's recognize it. Everybody should remember, if you're in municipal finance, 5% non-call term bonds will be refunded. You cannot find any more than 10 years old. They don't exist. They have been refunded. But it won't happen unless because the infrastructure wants callable bonds. That's how they get paid. The American Bar Association is the biggest promoter of restoring the advance refunding. You wonder why. The attorneys, the advisors, the underwriters, everybody wants to see action. And the issuers love to disclose savings to the constituents. And all you see is the savings. You don't see the cost of the call option. You don't see how much they pay for the call option at issuance. So I'll finish with this. So what should be done? I'll give a very simple solution. People should learn finance. I mean, that's the only thing I can tell you. Basic finance. This is not new. This goes back 30, 40 years. And it's being used elsewhere. Why it is not being used in the municipal finance area, I do not know. And I'll finish. Thank you.
I'm Alan Garman with the Maryland Transportation Authority, and so I thought it would be interesting to maybe respond to the paper from an issuer's perspective. And I was in the midst earlier this year of a Build America bonds. The refinancing was about $700 million, and I was approached with a tender opportunity. And I just wanted to relay that I think it's this right button that I push here or down.
The right
Oh, right here. Okay. Press harder. All right, here we go. So I found it surprising to be approached with an opportunity to refinance bonds that I'd issued years ago, and counterintuitive because I'd issued the bonds in a much lower rate environment. And so I couldn't conceive of how there could be savings for bonds when I issued in a lower rate environment. And I think about it like a home mortgage. You know, muni bonds are different in that you have sort of these limited call options, and you paid a lot of money for them, as the authors have pointed out, and you may have one chance to use them. You should use that chance wisely. And so, you know, I started to look at it, and I was presented with 75 different maturities. And so I needed to categorize those and analyze them separately. And it was a little bit reminiscent to me of the old advanced refundings that were often criticized as accepting some small savings today in exchange for basically giving up much greater savings in the future. So I threw in a couple of my favorite quotes that are kind of entertaining, and they're a little bit relevant. Is that, you know, the first quote is about the impossibility of trying to predict the future, and that's about rates. And I don't think that the decision to refinance is about a call on future rates. And I think, you know, the authors pointed that out. You know, the second quote is about probabilities, and I think about probabilities as, you know, probable cash flow savings now versus what I will get in the future, which is back again related to the option value. So one of the expressions I've heard misused and misapplied in our industry is a bird in hand is worth two in the bush. And so the way I hear the expression used often is that, hey, some guaranteed savings today is maybe better than, you know, this maybe larger savings in the future, which is uncertain because rates might go up. And so I'd looked some years ago about the original meaning of that expression, and I was surprised that it didn't mean at all the way we use it, and it didn't mean what I thought it meant. And the bird in hand was, you know, a bird of prey, your falcon, and its ability to go out and hunt for you. And so I think that that expression is actually more relevant, because I think of the bird of prey as the call option. I'm not willing to trade that really valuable call option for some small savings when there might be much greater savings out in the future. And so I think, you know, that reflects back to the last point, which is really critical to, you know, think about what's the value of that thing that you're giving up that you've paid a lot for at issuance. So one of the other things I try to do is, why are people doing this if it doesn't make sense at times? And so I try to think about it from a behavioral finance perspective. And, you know, Andy pointed out, you know, about there's this concept that, oh, if you've got 3 to 5% savings, maybe it's a good idea. You should accept it, even if really the savings should be 10 or 15%. And I've had instances where I've refinanced with less than that, and there was a reason. So I view that as an arbitrary number. It's meaningless. It should be ignored. And so if someone, you know, offers to you, oh, you've got 3 to 5% savings, I would say, you know, there's no basis in that. I had Garvey refinancing some years ago where we'd issued relatively short bonds, and when they hit the 10-year call date, there was only 2 years left. So there's not a lot of savings left there, and they were less than 2% savings. But, you know, what I explained at the time was that this call option is going to expire worthless in 2 years. If you don't grab the savings now, you can't wait around for some better rate environment. So that's sort of a point of how you can think of it as misapplied. And so I think really the better consideration is that the call option retained, you know, might be worth more than these current savings. So this table looks complicated, but it's really how I try to categorize these different 75 different maturities that I was shown. And so there were all types of different structures, some small premiums, some small discounts. Some of the bonds, if I issued them, they're all currently callable. I'm sorry, not currently callable. They all have call options. Some would be refinanced with optionless bonds. Some would be refinanced with callable bonds as well. So I put them in 4 categories, and I added the first category as sort of the impossible scenario, and it helps me make sense of it, is that if you can buy a bond in the secondary market at a prevailing market yield, and then you turn around and reissue the exact same non-callable bond, it has to be reissued at the same yield, so there can't be any savings. And so I'm trying to look at these and say, well, rates are higher now than when I issued them. Where's the savings coming from? And so the second category there is a callable bond trading, at a small premium or discount. When I reissue it, it won't be beyond 10 years, so it's going to be reissued as a non-callable bond. And so when I looked at these group of maturities, what I realized was that the break-even rate change was relatively small, meaning that I should be indifferent between doing this tender now or just waiting until the call date. But that's not even, it's sort of ignoring the value of that option, is that maybe a small decline in rates and I'd save a lot more money. And one of the things that I realized was that there's an illusion of savings when you change from a callable bond to an optionless bond. And the example that I would give is that if I issued bonds today, tomorrow someone could approach me and say, hey, you can tender those bonds and refinance them and save money. And that would just be simply because I'd be exchanging a callable bond and in exchange for a non-callable bond. And so, if I'd issued non-callable bonds yesterday from the start, I would have gotten a higher price for them. So, why would I change my mind the next day and just issue, non-callable bonds? And I think the only point is that there is that element in some of these tenders where you're giving up the call option, and so it looks like there's savings, but it's there. The other 2 categories, 3 and 4, were a similar group of bonds that have call options, but I would be exchanging them for optionless bonds. And in that group, I saw that instead of rates needing to decline slightly for me to break even, on average, it was a 40 basis point increase in rates. So you mean to tell me that even if rates rise, I'd be better off waiting for the call date? And so that was, illustrative to me. And then the 4th category was even more complicated because it's a bond that has a call option and I'm exchanging for another bond that has a call option. And I think, in the paper, it's talking about, you're giving up a call option, you're gaining a call option, you need to value both of those. I've got 2 minutes. Okay, so I'm on the second to last slide. So the third option was, or the last one, it was really the only ones, and they weren't addressed in the paper. And I realized that I issued a very unusual bond back in 21 with very low coupons. And these bonds, as interest rates rose, they started to trade at a discount. And in fact, they fall off of a bit of a cliff into a deep discount territory because a portion of that discount becomes taxable at ordinary income. And so it a bit violates that first line item, is that in theory, I could buy them in the secondary market at a high gross yield and reissue them at a lower yield. So that was really the only case where I thought there might be some value in exercising the tender. So, I have a few observations and a couple of questions really for myself and the authors, is that most of those candidates appeared suboptimal to me. And at times there's some illusion of savings when you're exchanging a callable bond for an optionless bond. And I agree that, you should look at the call option values when you're making that decision to give up something that you've paid a lot for at issuance. The only instances where I found it made sense was maybe with some of these deep discount bonds. And again, that's not addressed in the paper because it's an abnormal structure that we issued in 21 in a super low rate environment when I understood that banks and some other institutions had an appetite for that. And the last question I might answer for myself, and then maybe, Andy could answer it, is that, why is the industry failing to consider the value of the call option and these tender refinancings when they're at or near par? And I think part of it is they're falling back on this arbitrary heuristic, and they're thinking, oh, I'm grabbing a little savings today. Maybe that's better than uncertain savings in the future. But I think they're, I think they're, uh-oh. So anyway, that concludes my remarks. Thank you.
Very helpful presentations. And Andy, perhaps you could start with the question that Alan raised there at the end. And Alan, maybe you can, if you wouldn't mind restating the question.
Yeah, I guess I just, wonder. I wonder aloud. I know in your paper that you looked at the transactions that actually occurred. So there's probably a lot of issuers that have passed on tender transactions. So maybe that's part of the answer, is that some of the issuers like myself have looked at pieces of them and decided, maybe they're not that compelling. I forgot to mention that, I had been in the midst of looking at those, and then a ship hit the Key Bridge and knocked it down. And so my attention was, rightfully diverted, but I still found that maybe some of the deep discount structures were compelling, but I thought the other ones were not at all. So I think the question is, why have some issuers maybe come to the conclusion, particularly with these premium structures, why are they giving up the call option for small savings today in exchange for much greater probable savings in the future?
I look at these transactions as purely speculative. I don't see any value of it. I have not seen any discussion in any presentation that says, oh, this is a good idea because, give an explanation. It's purely speculative about where rates are going. So I think most issuers thankfully recognize that, but some of them do not. And they pay 3 or 4 points above fair market value, and then they hope for some miracle. And that's how I see it.
Other questions on this paper? Yes. Daniel?
I was thinking about this alongside the earlier paper showing the exit of some of the...
Your name, sorry.
Oh, my name is Daniel Bergstresser. I was thinking about this paper alongside the earlier paper on the exit of Citi and UBS, and I was wondering if it's possible to distinguish among underwriters in terms of their enthusiasm for, Andy, what you view as maybe not issuer-friendly proposals about different restructurings. Do you distinguish, are you willing to name names, say, well, UBS was the worst, and now that they're out of the market, we might see less of this? Or is this pervasive enough that it's not possible to distinguish between underwriters in terms of their enthusiasm for these types of things?
I try to address the perspective of the issuer without any reference to either the underwriter or the municipal advisor. I would leave that to Alan.
Yeah, respectfully, I would do the same. I think, the underwriters bring a lot of good ideas to us at the times. We did a BABS refinancing, which was one of those counterintuitive refinancings where we were exercising a make-whole call that was based on treasury rates that had risen, and we're able to refinance at muni rates. And the market's been abnormal in recent months with munis trading at a low ratio relative to treasury yields. So, I think there are abnormal markets and there are counterintuitive refinancing abilities, and I think there's value from advisors and underwriters to bring ideas. So it's an idea, but it's up to the issuer and their advisors maybe to work collaboratively together, look at the option value and say it's a good idea or it's a bad idea. I don't think that's the role of the underwriter, is always to make the recommendation, because that's not their duty, but it's the advisor that needs to be advising the client, the issuer, about, is this a good idea to refinance to use your call option or not?
But if I may point out, that's a little bit different because you're referring to taxable bonds.
Yeah, the BABs that we were
And the situation changed because the federal subsidy changed and so on.
Right.
So that has nothing to do with the 5% non-class 10 bonds that I'm referring to, which dominate the municipal tax-exempt market today.
Right.
The process between the expectations from the different roles of the underwriter and the FA would be similar. Other questions about the paper? Mark.
Hi, Mark Kim with the MSRB. Andy, thank you to you and Marty for this timely paper at a point where tender transactions are widely being pitched in the industry. And Ellen, I appreciate your really insightful perspectives and comments from the issuer side as well. So terrific discussion there. I wanted to ask Andy, your thoughts. Your focus on this paper was really about how inefficient these transactions are for issuers. But I wanted to get your thoughts on the flip side, which is how beneficial these transactions should be for investors who are being offered 3 or 4 points premium above fair market value, and why every investor shouldn't be knocking down the door to tender
Mark,
their
it's a great question because the premium is generous. Let's recognize it, 3 to 4 points. I alluded to some of the problems. One is that the gain, if any, it would be taxable as long-term or short-term capital gain to the investor. The second is that, as I mentioned, some holders, some investors are constrained to hold the bonds for accounting reasons, and so they could not sell. But I agree with you that these seem like very generous premiums to pay in the tenders. The corporate tenders that I was referring to, they were about 2.5, 3 points. But taxes and accounting play an important role. That's all I can say.
We had a question right here in the middle.
Just going to ask a naive question and say, Dan Garrett, Wharton. A lot of this, of course, the bonds being designed to churn these 5% coupon callable bonds that are going to be called at par, comes from the fact that no one wants their bonds to be trading at a discount rate, right? So no one wants their bonds trading in a discount region, so you're going to price it in a way when it's made to try to get out of that region. I was wondering is that kind of the main reason we're stuck in this churning world, or are there other reasons that we should be thinking about, or is that totally off base?
Why do we have 5% bonds, basically? Is that your question?
Yes, that's the question.
5% bonds make a lot of sense. Don't misunderstand me. Premium bonds are desired by institutional investors because they want to avoid, at any cost, the de minimis risk. They don't want the bonds to fall below par. So if you sell a bond at 120, it's very unlikely that rates will go so high that above 5%, so they will go to a discount. There's nothing wrong with premium bonds. The problem is the par call in year 10. That's the issue. And I'm not the first one to suggest that those call prices should be raised drastically. Maybe in year 10 it should be 115, coming gradually down to par. But the main point, there's only one point, Alan referred to it too, is that bonds should not be refunded if the current rates are actually higher than they were at the time of issue. The whole point for the existence of the call option is to take advantage of lower rates, not to refund and show savings. And the municipal industry has completely lost the perspective on this, and they keep on talking about savings, when in fact it's very obvious with perfect hindsight that you would have been much better off to have issued an optionless bond and left it outstanding. It would have cost a lot less.
It seems another solution, though, is just to get rid of the de minimis tax and get rid of capital gains taxes on munis. To kind of free up.
Just repeat that.
It seems like another solution would be to eliminate the de minimis tax and to get rid of capital gains on municipal trades.
In my opinion, based on theoretical study, the right solution is to issue optionless bonds, shorter, longer bonds, you can prove, and I mentioned in one of my slides, you can actually show that the expected cost of fairly priced optionalized bonds is lower than fairly priced callable bonds.
Alan, did you have any comment on de minimis?
I do not. I do not have any comments on tax policy.
Nor do I.
But underlies, if I can make just one comment, which I made before, the question is, how do you value bonds in the municipal market? What's the discount rate? And I will tell you something that you should all know, but probably don't. The right way to discount tax-exempt bonds is to use the issuer's taxable rates, not the tax-exempt rate. Because from the municipality's perspective, that's the sensible way of doing it. And once you start doing it correctly, suddenly you can see the light.
Okay. Well, thank you very much for your good questions, and to our presenters.
This is very good.
Yeah, I don't know. We have your names here. So there. Welcome back, and thank you for an interesting session. I think Andy, if you keep making this speech often enough, somebody will listen someday. So I'm really proud. I'm really pleased today to have three mayors from very different small cities. As I mentioned earlier, Mayor Bynum of Tulsa is going to be remote, I hope. But let me start with Brett Smiley is the mayor of Providence, and he's been mayor of Providence since January 2023. Before that, he, among other things, was chief of staff to Gina Raimondo, when she was governor of Providence. Providence is a city of 190,000 people, about 2/3 Black or Hispanic. The population's been growing slowly, although it's still below its peak. Has an unemployment rate of slightly over 4%. The city went heavily for Biden, of course. It has a bond rating, a BBB+. Mayor Reed has been mayor of Montgomery since November 2019. Before that, he was the elected probate judge. Montgomery is a city of about 200,000, about 2/3 Black. It's kind of been overshadowed economically by Birmingham, which is about the same size. Their population is stable. The unemployment rate is very low, 2.6%. The Montgomery County, I couldn't find the numbers on the city, went heavily for Biden, 2-1, and it's a AA rating. And wow. Mayor Bynum, it's like you're on the Jumbotron here. We really appreciate the efforts you made to get here, heroic efforts. I said to somebody, we'll have to allocate you an extra 5 minutes. I guess I should look here, right? So Mayor Bynum is the mayor of Tulsa, a city of a little over 400,000 people, 2/3 of it white, has a stable population. Its unemployment rate is a little below 4%. Tulsa County was heavily voted for Trump, and Tulsa has a AA bond rating. Mayor Bynum was on the city council for a while, and he served 4 terms on the city council, in fact, and then he ran for mayor in 2016, was reelected in 2020, and I guess he's had enough because he's announced he's not running for another term, and he's going to be vice president for community and government affairs at the St. Francis Health System. So local politics wasn't interesting enough. He's decided to go into the calm world of hospitals and healthcare. So I thought I'd like to talk to each of you a little bit about your experiences, and then we can see what issues you have in common. Mayor Bynum, maybe I can start with you. So you've been mayor for 8 years. It's been a tumultuous 8 years in America. You've had some interesting conversations about race in Tulsa because of your history. I wonder if you could just tell us, like, what were one or two of the biggest challenges you faced as mayor and what lessons you learned from them?
Well, first, I apologize for not being there in person. I have had 3 different flights get canceled in the last 24 hours. So, and by the time I could have driven, I would have had to drive all night. So I'm sorry to miss it and to miss the chance to be there with my colleagues who are great mayors. I think for us, you know, you mentioned we have faced just about every challenge that you can think of. We are in Tornado Alley. We're on the Arkansas River that is flooded during my time in office. We've been hit by tornadoes, a polar vortex, a derecho, which is like a tornado, but over 15 miles wide. Boom and bust economy, the largest healthcare challenge or crisis probably in American history with the COVID pandemic, and on and on. No locusts yet, but just about everything else that you can think of. Honestly, I think probably the greatest challenges that any mayor faces, in my opinion, are the things that you don't have control over. Yeah. And one of the things I've really tried to focus our team on at the city would be the things that focus on what we can control. We don't have control over our local K through 12 education system here in Tulsa, and yet that is going to be one of the biggest indicators of any city success. So how do we influence that and use everything that we can to help schools in our community while not having any budgetary or executive authority over our local schools? Certainly, and you mentioned the issues around race, which we have worked to address. Tulsa was home to the largest city-based race massacre in American history in 1921, the 1921 Tulsa Race Massacre, coming in second place for the horror of that event was that nobody talked about it for about 80 years in our community. It was almost entirely covered up, and so we've spent the last 20 years working to try and educate people about what happened. We are searching right now for the graves of victims. In fact, just last week, we had the first DNA identification of a World War I veteran who was killed in that event. His family did not know where he had been for the last 103 years until we notified them last Wednesday that we found him buried in our local cemetery in an unmarked grave. So, and when it comes to issues of race, these are not technical challenges. They're human challenges. And for us as a city, the challenge for us is that the city didn't do the right thing for so long. And so we have not earned trust from our citizens. And yet, you know, I wasn't around 100 years ago or 70 years ago or 80 years ago, and have come in as mayor trying to do the best, but I inherit the mantle of an organization that has a very problematic history with race in our city. And so how do you lead through that has been a great challenge. The last thing I would say, though, and I think probably relevant for your conference, I came in as a city councilor in April of 2008 with no notion that I was walking right into my first elected position right as the Great Recession was beginning. And at that time, Tulsa had no reserves at all. And I spent my first year sitting in the city council chamber filled with police officers and firefighters, their spouses and children, begging us not to lay them off. And these are heroes who risk their lives every day to protect our citizens, and there was nothing we could do. We have to have a balanced budget as a city government, and that made a great impression on me. And so as a councilor, again, focus on what you can control. I wanted to try and prevent that in the future. Authored a city charter amendment, which was approved by the voters that created the first rainy day fund account in the history of the city. And then as mayor, got voter approval for a dedicated sales tax funding source for our rainy day fund that brings in now millions of dollars every year. And when we went through COVID, because of those reserves that we had built up, we had no layoffs. We didn't have to lay off a single employee, even though we saw a dramatic decrease in revenue. We also didn't have to rely on federal funding to bail us out. But it was because we had spent years preparing for that type of challenge. And I'm thankful that voters have approved those now twice, and that future mayors and future city councils won't be placed in the position that I was back in 2008 of being painted into a corner and powerless to protect those who risk their lives to protect the rest.
Let me just ask you to clarify two things, if I might. One is, so the reason you don't have control over your schools is because the state has taken them over. Is that what happened?
So, well, we never had, they
I
are
see.
independently organized. They
I
have
see.
their own school board. That school
see.
board appoints the superintendent. And the state of Oklahoma derives the funding. If we were to pass and we're the only state in our region that has this requirement, by the way, if we were to pass an initiative that helps supplement at a local level funding for our schools in Tulsa, the state reduces their allocation from their funding formula to our schools by an equivalent amount. They punish us
I
for
see.
trying to help. We've tried to change that too, again, with little success.
And COVID, did you get COVID relief funds or not in Tulsa?
We have, yes, but because we had not, because we had been able to rely on our own reserves to keep the city operating, we didn't have to use those relief funds from the federal government to shore up any sort of deficit, an operating deficit, or to supplement operations for the city. Instead, we're able to put those funds into a lot of public health and improvement initiatives that I think will make a huge impact for the good in Tulsa over the long term.
And will those continue after the COVID money runs out? Is all those permanent programs?
A lot of them are capital improvements,
I
so
see.
they are not operating intensive. That was another thing that I learned early on as a city councilor. When you get federal grants, you need to be mindful that when they run out, if you've used those to hire people, then you're either going to have to bring those people onto your general fund or you're going to have to lay them off. And I didn't want us to be in that position either way. And so one of our main criteria in utilizing our coronavirus relief funds as well as our American Rescue Plan Act funds was we did not want to use them to fund ongoing city operations. There are a few things that would be like minor that we use to test out an idea over 1 or 2 years. If it's proving its worth, then the city might want to fund it through its general fund. But this council and I were very disciplined in not taking on any major ongoing operational expenses through those one-time limited funds.
Great, thanks. So every city has unique issues. They have issues in common: housing, crime, COVID, racial polarization. But I know, Mayor Smiley, that one of the issues that you've had to deal with in Providence is that a large part of your tax base is tax exempt. As I understand it, something like 40% of your tax base. And you do get some payment in lieu of taxes, but it's been an issue you've been dealing with. So you talk a little bit about what the challenge is for you and how you cope with it.
Yeah, this is, it's not unique to Providence, although I think we're at the high end of the spectrum. Providence is both the capital city of Rhode Island and the home to 4 private colleges: Brown, Johnson & Wales, Providence College, and the Rhode Island School of Design, plus campuses for 3 public colleges. In Rhode Island and most of the Northeast, we are funded primarily on property taxes. Property taxes make up about 80% of the city budget, and 48% of the land is property tax exempt. And so that is a math problem every year. And so last year, my first year in office, we had the opportunity to renegotiate payment in lieu of taxes agreements with the 4 private colleges. And through about 9 months of negotiations, we were able to negotiate a 20-year agreement that was a doubling over their previous payment. And at least by our math, now the most generous, from the city's perspective, agreement of its kind around the country. These things exist in other places. For us, the most frequent comparisons are always to Yale and New Haven, and then Boston and all the colleges in Boston, and certainly compared to those 2 cities, either as a percentage of property value or a percentage of land mass, they're paying more dollars per value or per acre than they are in our competing cities. And so it has made a meaningful difference in the city's budget. We're underway with negotiations with our hospitals right now as well, which has been a slog, and we've not made as much progress as I would like. Again, given the nature of Providence as a capital city, we've got most of the state's healthcare infrastructure in Providence, and these institutions don't pay as well. I have I had a very old boss, a former congresswoman that I used to work for, who used to say, "Nonprofit doesn't mean no money," and that has been our orientation. We want these organizations and institutions to thrive, but at the same note, we still provide fire service, we still provide police protection, we still plow their streets, we still fix their sidewalks, and so with Brown in particular. Brown has a larger budget than all those other institutions, and so we ended up doing a secondary agreement with Brown, and there were actually some innovations in there, in addition to just payment in lieu of taxes, which all the other institutions paid. With Brown, we also tried to align interests, and so, for example, there's no incentive right now for our colleges to ever put a property back on the tax rolls. And so we built into the agreement a mechanism whereby if they actually sold a building that became taxable again, they could get some credit on what they are paying us in order to give them a little bit of a motivation to do so. They worked with us also, and this is a sort of a tool that I've been very hesitant to. I haven't used it yet, but it's at my disposal now, where they are willing to allow us to draw from future years' payments for catalytic economic development investments if we needed some subsidy or some other dollars to try to fill a gap. Now that's, robbing our own future payments, but that flexibility may come in handy one day, and I've tried to be very disciplined about not making that look like a solution to every prospective gap that there is in the economic development landscape right now. But it's a meaningful change, and speaking with many colleagues around the country, this is not just a Providence problem, and for local government that's so dependent on property taxes, the growth and proliferation of these large tax-exempt institutions puts a real strain on local budgets, and we all need to figure this out differently.
Mayor Reed, you have the benefit and the curse of also being a capital city. And I wonder, but as I mentioned, and I didn't make this up, you told me this yourself, in terms of the economic engine of Alabama, Birmingham has been seen historically as being the industrial capital of Alabama, indeed the South. You're overshadowed by cities like Atlanta and Nashville. So I'm curious about how you've built an economic development strategy, what's worked, what are the frustrations in getting development in a city that needs it?
Yeah, first of all, thanks for having me. It's a pleasure to be with you and join my colleagues. Those who are running America's best cities during this time is certainly a great opportunity to hear some of their approaches and ideas to this topic. For me, our city has been run on a very conservative platform as it relates to philosophy. I would sum it up by saying keep it small and keep it all. That has been the mindset of many of our leaders and many of our more so business community has been not to grow, has been to just rely on the state capital and to rely on the manufacturing base that we've had for decades, and to rely on our military presence that we have with Maxwell Gunter Air Force Base serving there. It has not been one that's been progressive. It's not been one that's been forward thinking, and hence we've suffered. We suffer from the brain drain of our best and brightest going to larger cities in the region. Usually, again, that's in Atlanta, Nashville, Birmingham, Charlotte, some of those cities. And we have not kept up. So when I came in 2019, I came in really with a lot of things I've been trying to push since I was elected to a judgeship in 2012, which was how do we transition our economy? How do we get more so into knowledge-based economy using our colleges and universities as anchors, using our state government as an anchor, using our military. Really, it was looking at what the Research Triangle had done in the 70s in Raleigh, Durham, in those cities there. So when you look at that area, they understood where the trends were, and they understood kind of how to leverage the great colleges and universities they have for federal funding and R&D to help propel economic development. we are just getting to that point around our I-85 corridor, which encompasses Montgomery, Tuskegee, Alabama, as well as Auburn, Alabama, and trying to leverage that. So we've had to really bank on our tourism for being a tremendous driver of our economic growth because of the civil rights history. Montgomery is the birthplace of the civil rights movement. It is the place where Rosa Parks took her defiant stand in 1955, and where Dr. King, at the ripe age of 26 years old, led a 381-day nonviolent movement of protest that not only changed the city, but changed the state and nation and beyond. So there's this interest around this tourism and all that took place in our past and how we, related to many of the things we see happening today, whether it's around healthcare disparities, education, and certainly economic disparities that really fall along the lines of race. And there's a driver there, and there's been an active movement, I guess, among our Convention and Visitors Bureau to capitalize on that, right? But one of the things that I say all the time is we aren't going to profit from it if we don't practice it. So we're not going to be hypocritical in the things that we market through our CVB to visitors and then not implement those things that relates to poverty, as it relates to race, as it relates to class. I just refuse to be a party to that. And so that creates friction, not only for me at the city level, but also at the state level, because our state capital is not 2 miles from our city hall. So for us, economic development means making sure that we understand some of the drivers of the challenge that we have as a city, as a state, and as a nation. Montgomery is about 67% black. The state is about 26% black, but when you look at the economic indicators, you will see black businesses, over 90% of them being 3 employees or less, primarily in the service industry, with annual revenues well under $100,000. So you don't have a thriving black business community, and you don't have the working middle class that you should have among that population. So for us, even though we have led the state in the last 3 years for economic development in terms of job announcements, over $3 billion announced in about the last, since COVID, with about 5,200 jobs coming along with that. The most recent being Meta, opening its 24th data center, which is an $800 million project as has been announced, and we've been told it'll probably be well over $1 billion as they move forward. That's great, but we have to make sure that those announcements and the benefits from those jobs are really getting to the people who need it most. And what we've been able to do through public-private partnerships, which has been very, very key for us, as well as the partnership with the Biden-Harris administration, has been to leverage federal funds and impact investment to assist our entrepreneurs who don't have access to angel investors, who don't have access to private equity, who don't have access to corporate foundations, to help them get their ideas into the marketplace. So we have done a great job by all accounts in terms of industrial recruitment and jobs. What we have not done a great job in is making sure those jobs are getting to those that need it most, and making sure that some of the initiatives and policies that we have are helping those who have been left out, left behind, and looked over.
So in a project like Meta, so a data center, I don't know, does that, I know it's a lot of revenue for property tax. Does that employ a lot of people or not?
The data center would not employ a lot of people, but some of our other industrial projects like Manna Beverages and Amazon will.
So how do you get your community, the workers in your community, the skills they need to get those jobs? Well, how are you approaching that?
That's been a deliberate and intentional approach for us to make sure not only the companies that we bring hire local, but that they work with some of our community organizations, as well as our 2- and 4-year colleges, as well as our K-12 system, to start the process of what they need now, and to make sure that, again, we don't just do an announcement and we have a press conference, but we have the follow-through to make sure that people are aware of how they get access to these jobs, and then to follow through on the metrics. So we ask them to participate with us. We ask them to work with our churches, our mosques, our synagogues, everyone that's been a part of the community that continues to do the work. and then to let us know some of the things that we have on paper aren't working. One of the worst things that we've done in the past is not correct ourselves midstream. It's almost as if, well, because we announced it, we have to stick with it. Well, if it's not working, change it. Let us know that, after 2 quarters, and then we can tweak it and make some adjustments if you aren't getting the type of enrollment. So we stay in contact with them as well as their leads on the ground, and then we also make sure the community is letting us know, are you getting this information, and do you feel like you have the access that's needed?
Thanks. Mayor Bynum, one thing that's striking, at least in this city, in Washington, D.C., but I'm sure it's true in a lot of cities, is that the post-COVID remote work from home era is upon us, and it seems to be persistent. Permanent is a word I don't think we use about anything anymore, but persistent. And I'm wondering, what is that like in downtown Tulsa? Are you dealing with a lot of empty office buildings that are eroding your property base? How is it affecting how you see the course of the city in the next decade?
Well, actually, remote work has been fantastic for Tulsa. We had started an initiative back in 2018 or 19 called Tulsa Remote, thanks to our local philanthropic community. And it kind of got some play early on because it was, the city will pay you $10,000 to move to Tulsa and work there for a year, which was a little embarrassing at first. It's like, we're so desperate for people to move here, we'll pay you. But what we were pleasantly surprised by very quickly was so many people applied that it became a highly competitive process. In fact, the acceptance rate into that program ended up being more stringent than an Ivy League college. And at the time, remote work, just in, this is 6 years ago, 5-6 years ago, it was sort of this novelty. It wasn't something that was embraced by most of the major employers. And then all of a sudden you have 2020 hit, and suddenly a huge percentage of the workforce in America is learning how to work remotely very quickly. And what we found from that since then, we've had, Tulsa remote or not, we've had thousands of people move from areas where there's a much higher cost of living to Tulsa, because we've spent now, we're on a 20-year run of approving record-setting capital improvement programs that have built out a tremendous quality of life. And honestly, the big challenge for us right now is building enough housing to keep up with all the remote workers who want to move to Tulsa and do that work.
Interesting. What about the
other side of that coin? Yes, we've definitely seen a significant decrease in occupancy in our major office buildings in downtown. Our city hall is actually a former corporate headquarters. Half the building is city hall, half of it is private sector tenants. We've had some of those tenants who had 120,000 square feet of space with 20 people working in them, just waiting out the end of their lease. And so that does create a challenge. We've been pretty focused now for a couple decades now, mostly on our historic older buildings that have that smaller floor plate per building that are more amenable to being divided up into residential units. You get too big and it's hard to have window space and things like that in a building that you could convert into residential units. But we have, as a city, we have helped subsidize a lot of those conversions from office space into residential. One, from a historic preservation standpoint, to save some of the Art Deco masterpieces in downtown Tulsa, but also to help cover the gap that investors might see on retrofitting an older office building versus building something anew.
Mayor Smiley, it sounds like Providence has a similar forces of push and pull.
Yeah. Mayor Bynum could just say the same story and replace Providence with most of that. Remote work has been good for us on balance. I mean, there has been downsides to be sure, but net, it has been good for us. I think it has been good for, Dave, you said at the beginning, small cities. We prefer to think of ourselves as mid-sized cities, but I think...
Get into trouble no matter what
exactly.
I say.
I think second-tier cities like Providence pretty universally have done well in the era of hybrid work and remote work. In our case, we are in the shadow of Boston. We also are on the I-95 corridor with New York. And I was telling David a little bit ago, I was reading the Boston Globe on the way down this morning. The median house price in Greater Boston last month hit $960,000. And the median house price in Rhode Island is just about $500,000. The median house price in Providence is $370,000. So if you can have a Boston-based job that you don't need to go to the office but once a week and live in Providence, it's an easy sale. And we have people moving either with hybrid work arrangements or totally remote into our city. And so very much, as Mayor Bynum said, housing is now an economic development strategy. Probably always was, but it is very much central to an economic development strategy now. If you do not have homes for people to work in, and again, back to the college thing, in a college town like us, previously, we've had a fair amount of housing development over the last couple of years, but it's all been studios for students. And if you're working remotely where your home is also your office, you are not living in a studio. And so we've started to tweak some of our incentives and zoning to make sure that we're building the right kind of housing that can support this kind of work. We also do have the commercial office market. It's got about double the vacancy rate that it used to have. We have a relatively small downtown. We have a historic downtown, I think much older than Tulsa even. And those historic office buildings convert quite well to housing, and we were very much ahead of the curve. We've been doing residential conversions of historic office buildings since the mid-90s, and so have sort of benefited from being already well underway in that respect. But on balance, it has been a win for Providence.
How about you, Mayor Reed?
From our side, our vacancy rate downtown stems from the lack of investment until probably 20 years ago in our city as suburbanization trends took place, and obviously a lot of the downtown businesses and retail went to office parks and shopping malls. As that changed, around the early mid-2000s, we saw a rebirth in our downtown, only to be stopped by, as Mayor Bynum just mentioned, the recession probably right around 2010. That has now started to pick back up over the last few years. We're seeing more investment in our core downtown, again, because of the proximity to our state capitol and our state agency buildings, but also because it sits on our civil rights trail. It sits as a historic designation as the capital of the Confederacy. So we've seen more people come in with development ideas and development plans, and now our goal has been, and it was interesting talking to then Mayor Pete, now Secretary Buttigieg, about some of the things that he had done in South Bend to bring about a greater quality of place with walkability, more parks, and a change in infrastructure. That's new for our cities in Alabama. We are a car-driven society, so we don't think of people going from home to work to play on the scooter like you see right outside here at Brookings. Definitely be careful. Wear your helmet. But we have seen an increase in what we've also tried to do is to establish tourism improvement district, a TID, to help us along with some of this, as well as establishing a BID, business improvement district, to draw in those investors and to change our approach to have more opportunities for new market tax credits and things that will drive investors to look at our city and look at some of our empty office buildings to do those residential conversions, but also to bring more retail back in. One of the things that we're looking at a building as we speak, had this meeting on yesterday, it's a building right across City Hall that we're contemplating purchasing just so we can have the control capability of it to develop it, ideally for either an incubator or some type of small business space, one that is affordable. Because one of the things that we had a challenge with some of our developers, in particular those that are out of town and see cheap real estate in the South as a tax write-off as opposed to an investment opportunity, is that you can't price the rent so high when you're trying to get the train moving as if it's already going at full speed. And we hear that time and time again from those who want to rent downtown or those who would like to purchase downtown. So we have to kind of work with our private developers as well to try to shift it a little bit, and we've got work to do in that area.
Many cities in America have big problems with homelessness. I don't know much about either of your cities, so let me start with you, Mayor Bynum. Is homelessness an issue in Tulsa, and if so, how big a problem, and what can you do about it?
It is, and it has grown significantly, I'd say, over the last 5 years. And that has caused us as a city government to completely reassess how we are engaged in it. I would say historically, the role of the city government when it came to addressing homelessness was that we were a pass-through for federal funding. So HUD funding would come down to the city of Tulsa, and we would allocate it out to nonprofit partners, and it's kind of out of sight, out of mind after that. They would take care of things. But what we've seen is that that is not enough to address the challenges that we're seeing anymore. And so the city council and I just convened a working group over the last year to evaluate where within that homeless service provision ecosystem the city government can be most helpful. We also commissioned through our philanthropic community an analysis of housing in Tulsa. It was really interesting. What it came back and showed us was that there's a demand for basically every kind of housing you can imagine in our city right now, from homeless shelters to mansions. The market will take care of about 80% of that demand over time. There's about 20% of that the market isn't going to address. And that's things like homeless shelter space, permanent supportive housing, transitional housing. And the city has a real role to play in making that available. And so we put up for a vote last August, for the first time ever in city history, a vote to fund housing and homeless initiatives in Tulsa. Voters approved $75 million to begin that work. And so now we're very much focused on, we're one of the only major cities I'm aware of, and we call ourselves a major city. Thank you. We don't have a low barrier shelter, which would be the kind of shelter space, most homeless shelters are going to have rules on who is allowed in there. If you show up intoxicated, if you have a history of unruly behavior, if you have a pet, you may not be allowed in. And historically in Tulsa, if you weren't allowed in, then you just had to sleep on the street. Well, our new shelter that we're planning to open in November will basically be a referral for our existing homeless shelters. So if somebody shows up and isn't allowed in, they can call, and our referral shelter will pick the person up and give them a place to stay. It's little things like that. There's not one thing. I've talked with a lot of my colleagues. I think we're all looking for that one magical thing that everybody can rip off and find a way to pay for that would fix the whole problem. But what we're seeing here in Tulsa is that we have launched in the last 18 to 24 months 50 plus initiatives to test out ideas on this. My hope would be, in the next 2 to 3 years, we won't be doing 50 initiatives. We'll be doing 10, because we will have identified what are the things that are most effective and doubled down our financial resources onto those. And pulled back from the things that don't.
But just for the record, I grew up
we're really having to reinvent the city's whole role when it comes to addressing homelessness in a way that we never have.
So I'm intrigued. So you got a $75 million bond issue approved by the voters on homelessness. Was that controversial? Was it close call, overwhelmingly approved?
It was controversial in that it was one of the few times where we did not go out, usually you go out and say, well, we want X dollars to fix this street or to fix that park or to build this thing or to buy this many police cars. And instead it was, we need $75 million to address housing and homelessness without really a line item plan for how the money would be spent. And I'm really grateful. I think the voters recognized the extent of the challenge that we have as a city, and it passed by a landslide. It wasn't even close.
Interesting. How about homelessness in Providence?
Yeah, I mean, it's a problem in every American city. Our what they call the point-in-time count, our point-in-time count is up 150% from 5 years ago. The We're doing more in Rhode Island. We don't have county government in Rhode Island, so most of the things that would be at the county level are done at the state level. So the state is the primary funder of our shelter system, but the city's spending more money than ever. We are, as Mayor Bynum pointed out, kind of trying everything. We've deployed the first in our state of these tiny homes, individual homes that are going to open in another 6 weeks or so. Optimistic that that will help. We do have a need for a low barrier shelter. We do not have that. Our shelter space, we've expanded shelter capacity. Most of it is in Providence as the state capital and the largest city by far. They are often full, although not, it's kind of basically at capacity. With some controversy, I have a policy of not tolerating encampments in the city and working with social service providers and a lot of case management, but we don't allow any sort of permanent encampments in the city. And the root cause of it all is a supply constraint. It's a supply constraint on housing, and as the mayor said, at every level. And so, the actual long-term solution is dramatic expansion of the housing supply, and we've tried to take a lot of steps to do that, and tried to fight against. We were talking off stage a little bit. I mean, I have a very progressive city council. They're advancing a rent control policy that I oppose vehemently because it's not actually addressing the challenge. The challenge is a supply constraint, and that might actually further exacerbate the challenge. And so we just need to build more, and we need to build more dramatically. Fortunate for me, in Rhode Island, by statute, communities have to update their comprehensive plan once every 10 years. Ours is happening this year, and so I get to do that in my first term. And so we're doing dramatic across the board upzoning. And I will say one of the things, maybe like the Tulsa experience with this bond question, one of the things that's changed for us is if you go to any town meeting, generally the community comment portion is all no, opposed to any new development of any kind. And we actually have a community of people that are showing up to testify yes. If you're familiar with the acronym NIMBY, not in my backyard, there is a actually active organized group of YIMBYs, yes in my backyard, that are showing up at public hearings for homes and apartment buildings that they don't even live in to say, yes, we need more housing. Yes, this is a good idea to go up an extra story. Yes, we should allow them to not have parking minimums. Yes, we should allow them to do smaller unit sizes to be able to fit more in there. All the things that there are still people saying no, don't get me wrong, but it is a marked shift, and I think it's probably the same as the people who showed up and voted for that bond issue without a line-by-line accounting of actual residents in our cities that recognize that we have a very serious housing problem, and just saying I got mine and pulling up the ladder behind you is just not enough anymore. And so that is something that's very different than how it used to be, and very encouraging, actually.
How about homelessness in Montgomery?
Very much the same. I echo their comments as well. It is certainly relative to the size of our city. And we just had a homeless issue come up where we've now consolidated our major providers into one task force. They had not been speaking, not intentionally, just had not been communicating to one another over the last 10 years. And so when we brought them together, we said, look, if we can make sure that everyone's not working in their own silo, we're working collectively, that will help us form a better partnership from the city and with our county, and what we can ask for from some of our philanthropic partners, as well as some of our federal opportunities that we have. So that has been tremendously helpful, meeting now a couple of times a month to come up with ideas and solutions. And one of the things is from tiny homes to other initiatives that we're looking at, converting old motels on some of our in some of our older parts of town to make sure that they can be purchased affordably, redeveloped, rehabilitated, and then put as temporary housing is what we're finding. And I think this is important. Between the U.S. Conference of Mayors and the African American Mayors Association, we each have had some proposals that we have sent up the flagpole to the congressional level. What we're finding is more veterans are homeless. We're finding more women are becoming homeless along with their children. And what the challenge is, how do we get them to transitional housing and then obviously to permanent housing, given some of the federal rules around veterans and what they can apply for and what they can get. And then certainly at the state and local level, what can we do for those people who may be in a domestic dispute and are, fleeing their home or their children who don't have somewhere consistently to sleep, and how do they get to school each and every day? So there are some policies that we have asked the congressional delegation to look into, but we're also trying to do at the local level to assist us in this area, because it is a problem, whether it's Montgomery, whether it's Austin, whether it's LA, or even certainly here in DC, that you hear from mayors around the country. And the affordability crisis is my last point. That is significant. It doesn't matter if you're in the Deep South, if you're in the Midwest. Housing affordability is outpacing what the average person can afford. And that is a challenge, and I don't know if it is through rent control. I don't know if it's through another measure, but I can tell you what we have right now is not working. It's not sustainable. And Mayor Karen Bass of Los Angeles has led this initiative, both with the African American Mayors Association as well as with the U.S. Conference of Mayors. And it was a bipartisan group. Over 37 mayors came up to meet with their congressional delegation just 2 months ago to bring this issue to the forefront of our leaders here in D.C., because we've got to figure something out to address it. And I know the president has a plan for, I think, 2 million homes, affordable homes to be built, and that will come through HUD and I think maybe one other agency. But we've got to figure out from the local and state side, and I would even ask some of our thought leaders in this room from the private sector, how do we address that? Because there's not a mayor of a small, mid-sized, or large city that won't tell you that they don't have a homeless issue.
I feel like I should disclose that I grew up in New Haven, Connecticut, which is smaller than any of these cities. So your cities look big to me. I have lots of questions, but I want to give the audience a chance to ask questions. If there are any. Yeah, Krista. Wait for the mic and tell the mayors who you are, since they haven't had the benefit of hearing your paper presented.
Yeah, thank you all so much for being here. This was such a lovely discussion. So my name's Christos. I'm a professor at Arizona State University, and I wanted to focus on the housing and labor dimension. First on housing, I wonder, this is maybe like a framing argument about growing the pie, that if you just focus on rent control, you're just trying to cap things, but focusing on supply, then even the people that are sort of NIMBY, well, their property values are going to appreciate. They're going to be able to grow and expand. And so that was just more of a comment. The question on the labor side is, so many of the community colleges are underutilized, but they're also under-resourced. And so one of the exercises that could be useful, and maybe you've already undertaken some work to do, is mapping out the human capital that you currently have. So what does the census of occupations look like in the state, like occupations by industry? And then you see, where do we want to go? So what are the occupations we have today? Where do we want to go in the knowledge economy? And then kind of derive in a sort of roadmap. And then you identify at the colleges what courses are being taught. And those use like CIP codes. And then you can crosswalk CIP codes to the SOC codes, the standard occupational classification. So yeah, I guess the summary of that question is talk about the roadmap on the labor dimension and how you're going about it.
I'm gonna let one mayor answer each question so we can get more questions and get back. Apart from the hearing economists lecture you on rent control versus supply. So I think the underlying question is, what's your relationship with your community college system, and how are we doing at matching what they're doing with what you sense the demand for labor is in your community?
Yeah, if I can jump in, our community college relationship is great. I meet with the chancellor probably twice a year of our 2-year system, meet with our local H. Council Trenholm Community College in Montgomery, our president probably quarterly. One of the things that we find is that there's not the resourcing there from the state level, and because they aren't the 4-year schools, how do they get that help? And given where the price of 4-year degrees are going and how this current generation is responding to that, I think 2-year college is going to be more important than ever to help us in the labor supply. We just have to make sure that the policy, both at the state and federal level, reflects that, so you can get more of those resources to those programs.
Sir?
Thank you. Leon Peace. I'm with the American Bar Association Commission on Homelessness and Poverty. The question I have surrounding homelessness, the Supreme Court recently just ruled with respect to grants passed. What impact do you think that legislation might have on your city? And basically, grants passed allows cities and communities to criminalize basically sleeping in the city, within the city. You know?
Mayor Bynum, I don't know if you could hear that. The question was, what impact would the recent Supreme Court decision have that allows municipalities to ban the encampments? Has that been an issue in Tulsa?
Not really. The reality is we are very supportive of the grants passed decision, as I think we're a bipartisan coalition of governors and mayors across the country in advocating for that, because we've seen the real life implications of having your public rights of way opened up for encampments in particular. But we as a city had taken a position that really, for most of the rights of way that we would have, those are protected under the Americans with Disabilities Act. We actually have to bend over backwards to make sure that our sidewalks are clear, that we spend millions of dollars every year working to bring our infrastructure in compliance with that. And I issued a directive to our police officers late last year to make clear to them that it is illegal for people to obstruct rights of way in the city of Tulsa. It's illegal for people to trespass on property when it is posted that they aren't allowed to be there. And we have trespass letters from all of our major rail lines, from the state of Oklahoma for their transportation network, and for our park system, saying that people aren't allowed to sleep or camp out in those sites. And these things are already illegal under our ordinances. And so the police department is supposed to enforce our ordinances without making any presupposition about the housing status of the individuals in question. And so because we had that position in place, the grants pass decision, I guess it gives us further legal backing should that directive for our ordinances be challenged, but it really doesn't change anything about the way that we regulate encampments and sleeping and obstructing of public ways and public property in our city.
So, Mayor Smiley, you mentioned that you have a no encampment policy, but you also mentioned it was controversial. So you can talk a little bit about what's the controversy part?
Yeah, and I don't know that we're all on the same page on the grants pass decision either, so I don't want to think that, but the city of Providence at least did support the decision as it was rendered. But it doesn't, similar to Tulsa, it doesn't really change our policy. And I find, and this is something that maybe like the headlines are detached from what happens at least every day in my city, which is we have a thoughtful policy with respect to clearing encampments. It is generally speaking about a 30-day process where we give 30 days notice. We send multiple waves of social service workers to try to find placements, offer shelter beds, and then ultimately evict the encampment. By the time that 30th day comes, there's usually no one left, and we don't want to. I think we probably all agree that we don't want to criminalize homelessness, and we don't end up arresting people. But most of the folks who are in encampments in my city, at least, unfortunately, are used to this process, and they know that encampments in the city will be cleared. And every time, if there's 100 people in the encampment, which would be large for us, it's maybe 50. If there's 50 people in the encampment, every time a couple more avail themselves of services that have been offered, a couple more take an opportunity to go to a shelter, and it requires kind of constant working in a very progressive and social service focused way. The controversy is really in the form of advocates. It's not so much the folks who are unfortunately unhoused and in these encampments. It's advocates who are advocating for things like a sanctioned encampment or other designated spaces so that this process doesn't need to be fulfilled in the long term, and that's just not something that I can support. And so it has resulted in quite a few protests outside my office and occasionally my home, and that comes with the job. And part of the burden of this is to try to make the decision that's best for the community as a whole. And I don't think that permanent sanctioned encampments are good and not good for my city at least.
Let me ask you then each a final question. I'm interested in your relationship with your state government. How much does it constrain what you can do that your people would support, but the legislature won't let you do? You want to start, Mayor Reed?
Look, I'm a Democratic mayor in a Republican state of Alabama, so the conflict is real. It is there every day. Just got something as we were coming here. Some state representative over some committee, makes a statement about public safety in the city of Montgomery. I mean, maybe he ought to help our state get out of 47th place and every damn thing else that we're in, as opposed to talking about where we are with the city. So there's a very, there's a lot of tension between our city and our state legislature. Probably not as much with our governor per se, but with the legislative branch, there is that. So we constantly have to consider whether it's taxation, whether it's other, center-left policies. We have to always consider that the legislature does have home rule status in Alabama, and we can be overridden at any point. So for us, it is a part of the calculus, not just if you pass the city council, as we have done with things around taxation, but also whether or not the state will come back and then say you can't do it.
So be specific. You mentioned to me a tax.
Occupational tax. So that would have put $50 more million into our city coffers in an under-resourced city.
For people who live out of town and work in Montgomery, is that what it was?
That's correct. Yeah. And you had 26 other cities that have had it on the books for years, and when we passed it, our state legislature made it the first bill on their calendar in 2020. To take that away from us. So, talking to other mayors, regardless of their political identification, most of them said that same occupational tax would not only crush their cities, but it represents, minimum of 20% of their income.
Cities in Alabama or across the country?
And cities in Alabama. So that's always a challenge for us when we want to implement things that we believe will help our residents in the city, that the state from on high will come and use its power to preempt us in some cases and to react in others to take that local decision-making away from those who have elected their city council and elected a mayor to perform those local duties. So it's always there.
Is this an issue in Oklahoma?
Well, we have a couple unique issues. One, we have nonpartisan elections. I ran as a nonpartisan, but I'm a registered Republican with a very Republican legislature and a Republican governor. So I have a good working relationship with all of them. And I would say the state is incredibly helpful for us when it comes to economic development projects, helping companies expand in Tulsa, recruiting companies to Tulsa. They've been very good to us from a highway infrastructure standpoint. Beyond that, I would say mostly we're playing defense on especially, trying to prevent legislation that would be harmful to cities in Oklahoma from being passed. I'd say probably 90% of our legislative efforts are spent on that.
So give me an example. Give me an example of something that.
Oh, I mean, probably the biggest one is around education, what I talked about earlier, the fact that local communities in Oklahoma are not allowed to supplement funding for their classrooms. The thing that's very unique about us, though, as a city, and we've talked today about the Supreme Court, we found out that through a Supreme Court decision in 2020, the McGirt decision, that one day we went to bed thinking that we were not in a tribal reservation, and then we woke up the next day when that decision was announced and found out not only is Tulsa the largest city in America in a tribal reservation, we're actually at the intersection of 3 of them. And that has created a tremendous amount of challenge for us to navigate. You know, you think about all of a sudden you have 3 sovereign nations, if you can imagine, in the community where you live, actually 4 if you consider the United States, and then 3 tribal nations all overlapping within your community, all of which have different regulatory environments, different taxing priorities and environments, and different governments. And that's been, I think, a great challenge for us because our governor has a terrible relationship with each of those tribal leaders. And so we find ourselves as a city stuck in this spot between, we're part of the state of Oklahoma, but we're also part of these tribal reservations. And I'm elected by citizens of both. And how do we provide the best service we can for everyone between 2 parties who are fighting with each other, and mostly through the courts at this point because they can't reach an agreement on what our framework for criminal justice or taxation is going to be for the next, several hundred years. And so that, for us, I would say that's a much greater challenge for us as a city rather than anything dealing with the state government.
I'm beginning to understand why you decided not to run for re-election.
Right. You used to have a whole lot more hair. It was so dense.
And Mayor Smiley, how about your relationship with the legislature? And
Yeah, you have good diversity here because I'm a Democratic mayor in a heavily Democratic state, and so our personal relationships are very strong. And in terms of policy and ideology differences, they're not that wide. Although the Democratic Party is certainly a very big tent, and there's a pretty wide spectrum. I find the conflicts, and we do have conflicts with the state, to be sure. I find the conflicts to be more around levels of urbanization than politics. So suburban and rural legislators and even suburban governors versus governors from the city just have different priorities and see some of these challenges differently. The current governor and I get along fine. The city of Providence, historically, I've worked for a couple of the past mayors. We had a governor, a couple governors ago, who had a very suburban mindset and saw Providence and the other urban core cities as kind of like the source of problems to be contained, which is a very suburban mindset, and that we're still paying for the effects of that. And so when we're fighting legislation, and just like Mayor Bynum said, it's mostly playing defense. It is often suburban and rural legislators who are trying to prevent urban communities from being able to do certain things that are different. Our constituents are very different than, even though Rhode Island's a tiny place, we do have very rural communities and then a lot of suburban communities. And so that's where most of the conflict is. It's not so much with the leadership, and the interpersonal relationships are strong, and that helps, but the suburban rural urban divide is real, and it impacts policy that affects us.
do you think that Mayor Reed pointed out that there are things that the council would like to pass that the legislature would stop. You have my guess is you have a city council to the left of the state legislature. So is the legislature sometimes a check on the city council?
It is. My city, I'm a strong mayor, so I don't sit on the city council. I've got a legislative body, which is the city council. They are all, almost all of them are to my left, and they are to the left of most of the legislature, the state legislature, and the governor. And so there have been moments where the state has preempted the city in ways that I think are helpful for the city. And so, preemption is sort of whether preemption is a good thing or not is sort of in the eye of the beholder, and it often depends on the issue. More often than not, in our case, it has been more helpful. Although I'll tell you, when I go to U.S. Mayor's Conference meetings, generally speaking, it is something that is a net negative or a detriment to cities in other places in the country.
So I want to thank the three of you. I thank Mayor Bynum for your heroic efforts to get here. I thought we could have had a subsequent panel on air traffic delays. Mayor Smiley's plane last night was canceled, so he came in early this morning. Mayor Reed has good karma or something, so, though he mentioned he's missed a couple of. But mostly what I want to observe is that we live in a city where there's a great deal of cynicism about our elected officials. Some of it, I think they deserve. And what I always find inspiring about this panel we've done this in the past, is just how reassuring it is to meet three people like you who are mayors of your city dealing with problems on the front line, doing it so capably and being able to express the challenges you face in a way that we can all understand. So I want to thank you for coming, but I also want to thank you for taking on these jobs. And I hope you'll all join me in doing the same. So that concludes the conference. One request, you're going to get a survey from us if you were here at all or online. We hope you fill it out, both so we can make the conference better, but importantly to get ideas from the future. And again, I want to thank Hao-En and Meg and our RAs for being so helpful in making this run on time.